We've
What's calling to order the March 18th IMSARA Investment Committee meeting. Mr. Chair, roll call.
Trustee Cooper,
Here.
trustee Helwig.
Here.
Trustee Martinovich is absent. Trustee Poole,
Here.
trustee Robbie,
Here.
trustee Silverstein,
Here.
trustee Vasquez,
Here.
trustee Villa.
Here.
Trustee Werby,
Here.
trustee Healy,
Here.
trustee Jones,
Here.
trustee Shaw.
Present.
Mr. Chair, all members of the committee are present except for trustee Martinovich, which means that trustee Shaw will be voting in her place.
Okay. No board member requests. We'll now pause for an open time for public expression. Moving on to the agenda. And now we'll invite a manager overview from Jim Callahan.
All right, thank you very much. Good morning, everyone. We have maybe the longest investment committee agenda of the year today, so hopefully everyone's well caffeinated. We've got a large crew of Callanites here that I will introduce or reintroduce along the way as we get to various points, but we're going to start the day with two presentations from asset managers, and both provide something a little unique to MSARA, not something we talk about a lot. And so I'm going to do a little preamble for both of them, and I'll do them individually when it's turn. The first is Parametric's going to come on. Parametric basically provides a function where they overlay the cash that's in your portfolio, and they do a rebalancing function in your portfolio, and they use futures contracts to do that. They'll describe what that is, but you do not have a target to cash. Your long-term asset allocation policy has a 0% target to cash. And you know, the reason for that is that you have a very long time horizon, and over long periods of time, cash has a very low expected return. And other asset classes like bonds and equities and other things have higher expected returns that help you get to your actuarial discount rate. So cash has a 0% target. That said, you have cash in your portfolio on a daily basis. Your active managers have residual cash balances. You get contributions that come in. You have working needs where you have benefit payments that are going out. You have capital calls for your private managers. So there's a residual amount of cash in the portfolio, but a 0% target. So originally, Parametric, Clifton Group was the name of the firm originally, which was purchased by Parametric, was hired to help manage that residual cash and basically securitize it using futures contract. And again, they'll talk how they do that. So it takes away the slack of cash. It helps with liquidity management on a day-to-day basis. You don't have to be constantly moving money from manager X to manager Y to meet your liquidity needs, which can be very expensive from a transaction cost standpoint. Futures contracts are massive. They're deep. The transaction costs are much cheaper typically than moving physical securities back and forth. So it helps with liquidity management. And then years ago, we decided it would be useful to turn on the function that they provide, which is rebalancing using futures contract. So again, rather than when you have to rebalance from equities to fixed or whatever, because that can be very expensive, it may be more useful to use futures contracts or rebalance so that you stay within your policy targets. So they provide a very useful function. It's sort of like the oil in an engine, if you will. It just kind of keeps things going. So they're going to come on and talk about that program, how it works, what they do for you. I'll leave it at there for now. Happy to answer any questions. Otherwise, I'll turn the time over to Parametric.
Any comments before we begin? Okay. Let's go ahead and invite Josek and Dan Ryan from Parametric.
Thank you, Mr. Chairman. Thank you all on the committee for having us in today. Thanks, Jeff, and thanks, Jim, for that introduction. It's great to see you all again. My name is Dan Ryan. Those I may not have met previously, I serve as the relationship manager at Parametric, working closely with MSERA, with Callan, and with our clients across California and the Western Territory. And I work closely with my colleagues on our investment team, and I'm proud to be joined this morning by my colleague, Joe Zek. Joe is one of the senior portfolio managers in our Overlay Solutions group, and Joe is one of the key members of the team that implements on a daily basis the overlay program that we have in place for MSERA. So thank you for having us in today. We appreciate this chance to discuss the overlay program, to provide a reminder of what it is, the function that it serves, how it is structured, the components that are utilized, some of the instruments that are utilized to implement the program, and of course, how it's helped with the bottom line performance of the MSERA plan. As Jim mentioned, this is a pretty unique application. We recognize that it's a little different than many of the other managers you have in your portfolio. It's not specific to one asset class or silo within your portfolio. Rather, the overlay sits across the entirety of the portfolio, looks at it from a more macro level, and helps keep the portfolio aligned with policy targets. So this isn't something you're going to necessarily see every day. So we would encourage questions at any point to make sure that we are fully expressing and providing the details that you need to understand the structure and implementation of the program. And I want to begin also by pointing out that this summer we will hit our 25-year anniversary of managing this overlay program for MSERA. And that is a really tremendous milestone, and one that we are very proud of, right? We really are thankful, grateful for that partnership, and it's one that we're humbled by, to be able to work with all of you for so long and on behalf of the beneficiaries of the MSERA plan. So I want to begin by acknowledging that anniversary. We look forward to its official date on August 22nd, is when we launched it, 2001. So, but thank you for that partnership. Thank you for your trust, and thank you for allowing us to work on behalf of your beneficiaries. Before we delve into the specifics of the overlay, I know you've heard this about Parametric, given those 25 years, but maybe we'll give a quick reminder of the firm before we get into the details of the program. Parametric as a firm, our specialty is in building customized exposure management and risk management solutions for our clients. The key to that is to understanding each client's situations, what their priorities are, what their challenges are, what their objectives are, and then taking that input and building a customized portfolio to meet those specific needs and objectives. And the different solutions that we build for each client will vary based on each client's specifics. But particularly for our pension plan clients, for our public pension plan clients, they often take the form of these cash overlay programs. And so maybe we'll give another refresh of what a cash overlay program is. And Jim alluded to this, but it really comes down to the fact that you've spent a lot of time in your investment policy statement working on studying and coming up with your strategic asset allocation that will best deliver the returns you need to meet your liabilities and fund benefit payments for your beneficiaries. As Jim alluded to, that asset allocation does not include any allocation to cash, right? So your policy is saying you should remain fully invested into the capital markets according to those asset allocation targets at all times. The reality, though, is Jeff and his team also need to administer the plan, right? Benefit payments have to be paid each month. Capital calls have to be met. Expenses for offices need to be paid, right? There's a myriad of needs for cash on a regular basis. So your policy is saying don't hold cash. The reality is you need to have cash for a variety of purposes. So there's kind of this natural tension between these competing objectives. So how do you kind of balance those? And that's where the overlay program comes in. We can deliver market exposures in line with your strategic asset allocation targets in a very capital efficient manner, specifically using futures instruments that do not require the full use of your cash on hand. So you still have the access to that cash, you have the liquidity that it provides, the flexibility that it provides, but you're not losing out on the market exposures that your policy statement and your strategic asset allocation say you should maintain. So it allows you to kind of balance out those competing objectives. And it also helps with, as we'll talk about, and Jim mentioned, rebalancing purposes, helps with the performance of the plan, avoiding cash drag on the performance for holding that cash. But it also has other administrative benefits, allowing for kind of the ease of managing cash flows in and out. It serves a key function on the liquidity management of the plan, and it serves another source of resource of looking over the entirety of the portfolio on a daily basis. So Joe will come up and walk through the specifics of the program, the components that are utilized for the MSARA program, the structure of it. We'll talk about as well a refresher on the futures instruments that are utilized to implement the portfolio. And we'll walk through all of that. Please do ask questions at any point, and maybe I'll use that as an opportunity to see if there are, to this point, any questions that I can address or things that we should focus on for the next part of the discussion.
Yeah, let's keep going.
Got it. All right. Joe?
Okay, well, good morning, and yeah, appreciate the introductions, Jim, Dan, and everyone. It's good to see everyone. I'm one of the portfolio managers at Parametric that works on the overlay relationship for MSARA. I've been in this role for coming up on 12 years, and a lot of that time has been spent on working on the team that manages your plan. So it's good to get out here in person. First time I've been out here. Good to meet some people that I've exchanged these emails with throughout the years of the relationship. But as I think Dan and Jim laid a pretty good groundwork on why this is in place. So I think everybody understands that. So I'm going to jump into a little bit more on the instruments that we utilize to implement this program and some of their characteristics and why they allow us to, provide market exposure while still giving you on-demand liquidity to that cash. We touch on a lot of that information on this slide, so I'll keep that up here. But really some of the key points are the fact that these are unfunded instruments or margined instruments, really meaning that we don't need 100% of the cash in our account to provide this market exposure. Maybe best shown with a quick example. If you have $100 million of cash in your portfolio, we can add futures exposure on that cash. We can buy $100 million worth of futures exposure in line with your underlying asset allocation targets. We don't need that $100 million of cash. We do need some capital in our account. Exchanges require a small amount for what's called initial margin. We post that with the exchange for collateral. Futures contracts are also what's called mark-to-market daily. What that means is every day there's a gain or loss associated with the futures contract. You either receive a wire in if it's a gain or pay a wire out if it's a loss. So we have a small buffer for those flows. But most of our clients will only allocate about 10 to 15% of the market value of our exposure to our account. And that's similar with how your plan operates today. So of that 100 million in my example, we only need about 10 to 15 million in our account. The remaining 85 to 90 million can remain in your fund level cash account, can be used to pay those ongoing liquidity needs. We see cash come in all the time, cash go out. We're adjusting exposures. So it's not like a static amount we're holding. We're not seeking to add leverage on the portfolio, but just keeping our futures exposure in line with the overall cash that we see in the portfolio. A lot of different characteristics highlighted on this page, but that's really the kind of the key one. And you can see some of the types of contracts there cover a lot of the major equity and fixed income indices, commodities, other real assets. So there's a lot of different futures contracts available. We'll take a look in a few slides on the ones that are in use with your plan specifically.
Yes, hi. Quick question, before we get off topic of margins.
Yeah.
A few weeks ago, economist Torsten Slok actually puts out these daily charts, which I enjoy. We are at margin debt levels, record highs now, approaching 1.4 trillion on margin debt balance margin. Going back to 1997, it's almost 30 time. Are you seeing margin requirements increasing, and at what point does that become a systemic risk for your operation and what you're doing in terms of our overlay?
Yeah, no, that's a great question. And really there's two components of margin. One is what I'll refer to as initial margin. And I think that's what the article was likely referencing. So that's the amount that the exchange requires us to post for. So if we buy, a certain amount of an S&P 500 futures contract, there's a dollar amount per contract that we have to post with the exchange. That's non-negotiable. That has to be in the account. Usually that's around 5% of the value of the contract. The remainder amount is called variation margin, and that's the buffer that we have in place in case our positions move against us. We need to be able to pay wires out of that cash. So it's really that initial margin piece that can fluctuate, and you do see that change in terms of volatility, especially. So the exchanges are able to change that. For example, in 2020, 2008, when we saw heightened volatility, they can bump up the dollar amount per contract that we need to post for initial margin. Since I've been around, which, it's been almost 12 years, but even before that, 2008, I don't think that has ever gone above like 10% per contract. So we've never really seen it get too high, even in some of those extremes. If you think about the volatility we had in 2008 or 2020, we really haven't seen that go too high. That buffer piece can fluctuate in volatile markets where, if that dwindles because positions, if we're long equities, for example, that's the more common area where we've had to reach out to your group and say, hey, we're getting a little bit low on margin. We're not eating through the buffer, but it may make sense to true that up. So it's something we monitor continually. If it were to get too high, like 50%, if they bumped it up to something like that, then there'd be probably some risks to the business, right? Because now you're like, well, now we're getting closer to a fully funded instrument, maybe less benefits here, but we haven't seen it really get above, I want to say 10, even in the most volatile markets.
Yeah, I just
Yeah.
wanted to make a point about this program and there's no speculation going on here. There's no leverage. So to his point is that if you've got $100 million of cash, you've got $100 million of futures exposure. Right? It's not something in excess of that, which would then constitute leverage. So there are many that participate in the futures markets that are just using that minimum margin requirement, but they're taking $5 or $10 million and they're putting $100 million of exposure on. That's leverage. That's maybe more speculative. Certainly a lot of hedge funds do that and others in the marketplace. That's not what's going on in this portfolio. Right? Any futures exposure is backed by collateral and specifically cash. It's a very important distinction here.
One-to-one notional exposure.
Correct.
And we have the bandwidth for that, Administrator Wickman? Should it go, said margin requirements on the exchanges go?
They keep track of it. I think in the last 2 years, they've asked for additional margin cash twice.
And there've been times when they said, we've got too much.
Right.
Back.
They've also
Yeah.
given this back.
Yeah.
But
So-
it's only happened, as Joe pointed out, when there's extreme volatility and the markets move a large way in one way or the other.
But again, it's, the derivatives can be scary, and typically they're scary when there's leverage, and it's not here. It's important. It's just, again, this is like a lubricant to your portfolio that's backed by collateral.
So,
Yeah, that's a great point. I appreciate that. I'd say the vast majority of our overlay clients operate in that manner, where we have a very risk-controlled process in place to make sure we're not adding leverage on the portfolio, only overlaying, cash in the portfolio that's backing the futures. There are, as Jim mentioned, many other uses for it that can be leveraged, but that is not the intent here, and we're not seeking to add leverage to the portfolio.
Question? So I'm just trying to wrap my head around that. That's for the cash management. Is that also true for the asset allocation truing up, or is that separate?
Yeah, they kind of work together, but it is two separate components. So there's the cash overlay where we're exposing cash to the capital markets. And then there's what we'll call the synthetic rebalancing, where, if we monitor, we actually have, read-only access to your entire portfolio. So every day we're looking at your manager values, cash levels, the futures exposure we have. We're comparing each asset class to target and relative to bands that we have around each target that we've worked with staff and Callan to establish. So rebalancing exposure would essentially end up being cash neutral. So if we had to sell equities and buy fixed income, we might have to sell 25 million in equities to get that back to a neutral weight and buy 25 million in fixed income. So that's essentially a net neutral position when it comes to cash exposure.
And
Yeah.
the the requirement behind that is
Yeah.
you may need a little more in your margin account to affect the rebalancing,
Yeah.
especially
Yeah.
depending on the scale of how much
Yep.
you're putting on.
Yep. Yep.
But that could just, those positions could be more than $100 million, and they're different, right? I mean, equity exposures and fixed, right? So there is some, maybe I misunderstand, but it seems like there's some leverage outside of the cash management that is inherent in the fact that you're using these futures contracts to add or subtract different asset classes to get to the targets. But they don't behave the same.
No, you're right. And so when we sell futures for rebalancing, for example, that we look at that as that's creating cash. So think about if you had $100 million to an S&P 500 index fund, and we sold 2,500 or 25 million of S&P 500 futures, you'd have a net 75 million to S&P 500 exposure. So we're kind of looking at that as canceling out your physical exposure and creating cash. So our short exposure creates cash. Our long exposure is using up that cash. So it's kind of synthetic cash is the term you often hear.
And again, there's nothing
Yeah.
speculative going on here at all. It's,
Yeah.
they're just applying the policy that you've established, right? Which is, we're gonna get to in a minute, right? You have a target, you have ranges around it,
Yep.
and they're just they're just implementing that on a disciplined basis to do this, again, because using physical transactions to buy and sell, not only is it an administrative burden to have to move money around, but typically transacting physical securities is going to be a lot more expensive than transacting in the futures market, which are very, very deep and typically have much lower transaction costs. So there's an efficiency to being able to apply your policy through that program.
And you might have been getting at, they behave differently once we have them in place. So if we're short equities, long fixed income, we're still tracking that daily. So if the fixed income appreciates more than the equities depreciate in that scenario, we're showing that as using cash in the portfolio still. So it still kind of factors in not holding any more net long exposure than you have cash in the portfolio.
Mr. Silverstein?
So what we have in our asset allocation, let's just say 30% to some category.
Yep.
With a range of, let's say, 28 to 32.
Yep.
So do you exercise this synthetic rebalancing when we hit the extremes, that is the 28 and 32, or do you always try to keep it at the 30?
We would implement that once you're outside of those ranges is when we'd implement rebalancing exposure. So they are allowed to float. We're not looking daily and necessarily trying to keep everything exactly on target.
And we'll get into ranges a little more later as needed, but we're also, when we set those ranges, we're also cognizant of the fact that the markets move on a daily basis, and we don't want to have to affect too much rebalance, right? So if the ranges are too tight, you're constantly going to be pressing up against your ranges, either on the high or the low side, and it's going to be forcing transactions. We don't want to do that. We want to give them some room. That's why those ranges are set as they are, but it's only when they trigger the extremes when this happens. And then there are periods, and we look at that frequently with Jeff, and there are times where we kind of say, all right, well, we've been at the low end of the range for a while, and Parametric's been putting on positions. Maybe it's time to do a physical rebalance. So we will physically rebalance from time to time, but we want to be really mindful of the conditions and particularly of the transaction costs of doing it.
And that, what Jim just described, the physical rebalance, we look at that every month. We don't do it every month, but we look at the portfolio every month. And Callan takes an assessment, is it time to do a physical rebalance? And if it is, then we initiate that. But otherwise, that does not happen frequently. I think as a matter of fact, in the past 12 months, it's maybe happened once. Because the overlay program is keeping you within what you need to do so that we don't have to have a more expensive move.
And I'll just add, and I'll add when you do physically rebalance from Callan, we get all of those details, amounts, timing, trade dates, so we can adjust our futures exposure to line up with that activity as well.
I have a basic question.
Sure.
Yeah. So would you be looking at rebalance? You're looking at our portfolios with other managers. wherever they are. You just don't necessarily talk to them. You just monitor that and you act on your own. They're not aware of what you're doing. Right?
Yep, that's exactly right. Yep. I'm going to page ahead a couple. So I won't spend too much time here, but this illustration can be helpful for some, especially if you don't have a lot of history with futures. Really, we call it a synthetic indexing illustration. On the left-hand side, we're showing a physical investment in, let's call it equity. So let's say you had a S&P 500 index fund. The return really comes from two sources: the price return of the index, dividends you get from the underlying companies. On the right-hand side, we show that same investment. So let's call it S&P 500 futures. That's also tracking the price return of the index. The futures track that price return, but you also have all of that cash underlying the futures. So that's sitting in a stiff vehicle or any money market interest. And markets will keep that in equilibrium so that both of those are going to return roughly the same return. So that's kind of how the return works at a high level sense. If I look ahead one more page, we'll actually look at the futures contracts that we use today in your plan. So you can see the various asset classes that we track, the overlay benchmark index, and then the instruments utilized to the right there. That is all futures contracts currently in place today. So where available, some indexes will have a liquid futures contract we can use that track that index exactly. So the one example here, domestic equity small cap, Russell 2000 is your benchmark. There is a very liquid Russell 2000 futures contract that's used for that asset class exposure to overlay cash, to implement rebalancing. For most of the other asset classes, there's not a perfect match. As you can see there's multiple contracts listed, but we can get really good exposure. We actually worked with staff and the Callan team a while back to do a tracking error exercise and said, how can we best gain exposure to each of your asset classes? So large cap Russell 1000, that's a very common benchmark, but there's actually not a liquid futures contract that tracks that benchmark exactly. However, we can get very close and very low tracking error to that exposure by just combining large cap and mid cap futures in that space. Same for all of the other asset classes you see there. If I move ahead a couple and keep the questions coming as you see fit, but if I move ahead a couple, this is just a quick summary of the solutions in place. So we've talked a lot about cash overlay, rebalancing. We've talked a little bit about now. Transition overlay is one that's there as needed, not necessarily in use on an ongoing basis. What that is if you had, say, a manager redemption, maybe you're redeeming an international equity manager, you have a search going for a new manager, you might be out of the market for some time. Futures are a good tool due to that capital efficiency to plug those gaps. Moving ahead, we look at some of the gain loss over time. So this is, as Dan mentioned earlier, since inception, which is 2001. So this has been in place for almost 25 years now. You can see the graph up and down over time. When we're securitizing cash, if we were long only, for example, this is going to move up and down with the markets just like your policy index does. Not making any market calls, just providing that market exposure. You can see like 2008, you had a drop off. It's going to go up and down, just like other markets do. There are periods where we're rebalancing, so we're long or short in various asset classes. So in 2025, as an example, towards the end there, you saw we had a bit of a sell off. Equity markets were strong. We actually held short equity exposure since the physical portfolio was overweight, so we had some losses in 2025. But this aggregates everything: the cash overlay, the rebalancing, and you can see since inception, it's added about 9 basis points annualized to the total fund return. So it's provided some good real return over time, about 28.6 million. And I'd add we want to look at this holistically with the total portfolio as well. If we're rebalancing out of equities, it means your physical portfolio is overweight, so you're getting some benefit from that. So we encourage clients to look at that in combination with the physical portfolio.
What would this be net?
Yeah, so the reason we show that gross, so it'd probably be the exact same is the short answer. And the reason I say that is the return is a percentage of your total portfolio and not our exposure. So if we have 100 million in exposure, we're actually saying what's the impact on your total plan, which is I think almost 4 billion today. So it'd still probably round to 9 basis points, maybe 8. But that's why we do gross. It's because the denominator is your total plan assets and not our exposure.
Why don't we show it net instead of gross?
Question, Dan. So last year, it looks like the gain went from 60 million down like 50% to 30 million. I mean, it seems like every asset class was up last year. Can you explain? It seems like a 50% drop is pretty significant in such a short time frame. And then also the 9 basis points, had we just had that money in a money market fund or something, what would that have looked like?
Yep.
That had done better than 9 basis points.
Good questions. I'll address your first one first. So yeah, it's really the rebalancing exposure. So you can see even, I think it's 2021, I think it kind of peaked out where we were up like 65 million, somewhere close to that. And then, like you said, a drastic drop in 2025. There were recently target changes. So we rebalanced the portfolio. So we do have a bigger short position in equities today than we have. So it's really been a function of equity markets doing well and our rebalancing exposures being sizable enough that we've just had some losses there. Again, you'd see some big outperformance in your physical book, presumably, because you're overweight equities. But that's what happened there is we just had a large sell off. Compare it to 2026, where we've actually seen equity markets sell off. I want to say there's like 8 or 9 million in gains just year to date because of the short equity positions in the overlay. So it's really just that rebalancing function and the size of those positions.
Is it fair to say since 2020, the strategy's lost money? It went from 60 million down to 30 million? Am I missing? I just trying to understand the graph.
Yeah. But again, I'd look at this in conjunction, and we'll actually look in a couple slides at kind of cash overlay performance on its own, where we're just overlaying cash, and then we'll look at rebalancing. But again, especially rebalancing, I think you'd want to look at it in combination with the physical portfolio too, because had this not been in place, presumably Callan's staff would have been making physical rebalancing moves. So you wouldn't have had that overweight equity. But knowing that this is taking care of that, the rebalancing.
If we had a crystal ball, we would have not done this beginning in 2020, right? Mm-hmm. Because it's been really taking money away consistently from equities, which have continued to just roar, public equities, right? Yeah. And rebalancing to other things. But that's an important distinction here because this isn't speculative. We're not trying to really generate return with this. It's risk management. You have a policy, and sticking to your policy is one of the most important risk management tools that we collectively have on the investment portfolio. And this allows us to do that. So yes, it's been a detriment, but on a risk-adjusted basis, that's what it's been designed to do. But there can be times when it's certainly being a disciplined rebalancer doesn't work. Right? If I had known, I would have put it all into large cap U.S. equity in the March of 2009 and gotten rid of everything else. So again, we don't have those crystal balls. We want to be disciplined in terms of rebalancing and risk management. And that's really one of the important functions. Liquidity management, risk management, that's really important.
Mr. Healy?
So if we change the policy to net zero in cash and made it say 1% to provide us with the liquidity that we actually need, would it eliminate this potential exposure and these losses that we've had in the last 5 years?
If you were to put in some sort of cash liquidity buffer in there, the need for, an overlay may not be as necessary as it has been. We're going to get to this in a minute, though. Long term, you don't have a target to cash because it has a lower expected return, and it doesn't create an efficient long-term portfolio for you. Okay, so you don't have a target to cash for that reason. You still have liquidity needs, as was pointed out, and that's what this program helps manage. You want to get to the
Yeah,
question of
yeah, and it's
what it's done over time.
yeah, and Bruce, you had a question too on what if we just had the money market return on here? I think that was your second question. So I do want to call out. So this is the gain on futures only. So you still had money market interest that is not counted in this gain loss. So you're getting both here. So if we took the futures off, that 9 basis points just kind of goes away. You'd still have money market interest, but you're getting that in either scenario, I guess is the point.
So Trustee Silverstein.
So just to give me a ballpark idea of the returns here, what percentage is due to the cash management goal function, and what percentage is due to the keeping us?
We actually have that. Let's take. I'll forward to that right now.
Can I,
Yeah.
going back to the question about having lost money, I think it's a sort of a misnomer, because if you think about it, what happened is we got out of balance because we were making so much money on the equities. If we had done it right, we would have sold off the equities and we wouldn't have made the money. So it's just, offsetting those gains that we wouldn't have had. Because
Exactly.
And
Exactly.
and importantly, the costs to do that physically would have exceeded the cost to do this.
Yeah.
So it would be in excess of any number that you see here. If you were disciplined about applying your policy.
Can we say, can we compare it somehow to an insurance? Kind of? Like doing this at a lower cost? And the other question to follow up, in your example of 100 million, you only in possession of the margin, 10-15%, and the administration has the rest.
Yep. Yep, that's right.
Yeah, I don't know if I would, make a analogy to insurance per se. Again, it's just the most important risk control that we have, and the most important thing you do as a board investment committee from an investment standpoint is set your policy. It's your statement of risk. You have this long-term objective you're trying to achieve. You have beneficiary payments you need to make now and out in the future, and you're trying to do that in the most risk efficient manner that you can. And you want to be disciplined about that. That's the policy that has been adopted, and this helps you achieve that.
And so this program is not an inhibitor to cash. We have never had this program impact our ability to have cash at all. It works in the back, just like it's being described. It works in the background. We have our cash account. We use that. We pay bills out of it. So there's not a cash impact that this program creates.
In the interest of time and a full agenda, make a final push here and give us all your best stuff.
Yeah, sure. Why don't I address the one question then on breaking out the performance? So we actually have those two slides. So cash overlay performance. So had you came to us and said, hey, stop rebalancing, just overlay cash in the portfolio, get rid of your rebalancing exposure. This is what that would look like. I don't think you should do that. To your point, it's a risk management tool that should be in place. Happen to lose money as equity markets were up, but had we just overlaid cash, you can see there's actually gains in the portfolio. Table to the right here, up 3 million over the fourth quarter, 14 million over the whole year of 2025. So it reflects the fact that markets were positive. We have our system breaks out data going back to 2014, so you can see it's been a nice add back to 2014. Rebalancing, if I fast forward to that page, you can see that's really where all the losses have come from. But to your point, that was really just because rebalancing didn't happen in the physical portfolio. They were realized in the overlay program, and really the key part of that rebalancing piece is the tracking error comparison. So we did a rough calc on, hey, what's the tracking error with and without the overlay over 2025, and that's where you can see that benefit on the graph there. So maybe I'll pause there. Sounds like we're maybe butting up against time, and
Just one other quick point. We haven't experienced this for a while, but if you go rewind the clock back to the GFC, global financial crisis, right? Traditional sources of liquidity in portfolios became pretty illiquid. Bonds, right? We always think of bonds as being very liquid, and you have pretty core basic bonds. In many cases, those securities weren't trading, particularly corporate bonds and mortgage-backed securities and things like that. And so institutional investors, not everyone, and it varied depending on who you're talking about, but MSARA experienced this to some degree, were restricted in terms of their ability to rebalance. So even though you were drifting outside of your ranges because equities cratered, a lot of times you weren't able to transact in securities. You didn't want to like be buying and selling things. The cost of transacting was extremely, extremely high, whereas the futures markets were open. And so investors that were using futures to rebalance were able to achieve the liquidity and be disciplined about rebalancing during a time that was stressed. That's another advantage of doing something like this. Again, I hope we don't experience a GFC again. That was terrible. But again, that's just an added feature to using futures because they are so liquid and deep, exchange traded. So you've got, you're mitigating the counterparty risk. Again, I think we're beating this one, but just another point I want.
Any additional questions? Excellent.
Okay, thank you.
Okay, moving on to another,
Yeah, okay, you
topic.
thought that was, that was.
Securities lending with State Street.
All right.
John Powell.
I will attempt not to steal too much of to John's thunder here, but just a little background on what securities lending is and how you use it in your portfolio. So again, you have a bunch of asset managers who buy securities, equities, and fixed income in particular in your portfolio. And largely those portfolios are, a security is bought and sits in a portfolio, and the manager may not be transacting that security. It's kind of sitting there, and they may transact it if they need to add or trim, but they may be buying it and just holding it in your portfolio. There are a number of participants in the markets who find it useful to borrow securities for various purposes, whether they're hedging purposes or whether they're speculative purposes. And so what securities lending is that the owners of these securities, in this case, Amsera, using an agent, which is State Street, lends your portfolio. There's 4 portfolios that are eligible to be lent in your overall plan that are in a separate account format. There's a Russell 1000 index fund. There's a DFA small cap portfolio. And then there's 2 bond portfolios, Wellington and Dodge & Cox. So those are separately managed. The securities sitting there in your custodial accounts, and State Street can look through to that. And to the extent that they are able to connect you to someone who wants to borrow the security, they may borrow, just as an example, someone wants to borrow Microsoft stock. You own Microsoft stock in your Russell 1000 index fund. They can borrow it from you. What you get when they borrow it is they will give you collateral for that. So if you lend $100 of Microsoft, they'll give you actually more than $100. So they'll over collateralize you. And then that money, it's typically in cash or securities, high quality securities, that money can be invested, and you can get a return on that invested amount of collateral that you're holding while that money's out on loan, until the manager decides they're going to sell Microsoft. State Street is the agent, calls the security back, you get it back, and then you return the collateral to them. But while you're lending securities, while they're kind of sitting there doing nothing, if you will, you can earn income. So there's risks involved in it. You can get into it, right? You have the risk that the borrower doesn't give you back the security. You're indemnified on that. We talk about that a little bit. State Street as the agent indemnifies you on that. Second part of it is the investment risk of how you invest the collateral. Right? If you were to take that $102 that you get on the $100 and get really risky with it, you could lose a lot of money on it. So that money is purposely kept to be short-term, high quality, where you're getting just an incremental amount of return on that collateral reinvestment while the loan's on security. So that's kind of the basics of how it works. And Amsera has been doing this for a long time. I don't remember the exact inception.
The other thing too, I just want to point out, since it doesn't happen a lot, but you make this decision when you hire the manager. So when you hire Dodge & Cox, you said we want that to be lending. When you hired State Street, investment managers to do the Russell 1000, you wanted that to be lending. So that's part of your manager decision. If it's an equity or bond is, do you want it to be a lending or non-lending type of vehicle?
Thank you. Yeah.
I don't even know if I have to say anything. I'll stand here and look
Can you
pretty.
explain What STT is, because that's confusing too.
State Street Bank and Trust. That's our ticker, STT.
STT is?
Yeah.
It's all those S's.
Yeah. As I sat back there, I was just thinking of two quick analogies that explain what securities lending from an agency perspective is. One would be Parametric just spoke about their overlay product and how it kind of is a top-down look. We're the opposite. They're the roof of the house. We're the basement. We're reacting what you already own, and we're just trying to get some basis points out of what you already own and what your portfolio managers already buy. I've always said the traditional analogy is we're the air conditioner. The initial work is just doing some contractual work to decide what limitations you want to put on your program. You put it in the window, you set it and forget it. And you should just do our job. And knock on wood, we've had an extremely smooth run with your portfolio. No headaches. I think it's a very successful program that it provides to you with a nice revenue flow annually. Now, we don't deal with percentages. We deal with basis points because we're a secondary type of program. Just to tell you a little bit about us, and then I'm not going to talk too much about it, but an old senator in Illinois, Senator Dirksen, I believe his name was, once said a famous quote of $1 billion here and $1 billion there, and soon we're talking real money. It's 2026, it's $1 trillion here and $1 trillion there. Now we're talking real money. State Street has $54 trillion in custody assets, and that's our clients. And the markets rise, our numbers rise. Lending's no different. We have close to $7 trillion in our lending program. Now, out of that, we put out approximately $425 billion in our clients' assets around the world. We're a global product. We're 24/7 trading coverage. We have trading desks in Sydney, Hong Kong, London, Boston, Toronto. So your book is looked at, even though if you own a U.S. security, someone in any of those positions can put it out on loan and it'll be against U.S. dollars. They just forward the instructions to their New York desks and it gets executed. So you do take collateral. Anything we do put out is collateralized at more than 100%. Traditionally, it's 102% for any U.S. security. International will be slightly higher. And if we use like equities or corporate debt as collateral, it'll be 108%. Now, your program right now, all the collateral combined is about 90% cash. That's pretty consistent. The cash is put into a money market-like fund. It's called the Compass Fund. It's managed specifically for securities lending cash collateral. The big difference is that is we control the spigot of cash going in and out. So we keep it very smooth for the portfolio manager. If there's a cash drain because clients are pulling assets out or brokers are returning their borrowed loans and they want their cash back, we can raise cash with the other hand with other clients and other securities to keep it nice and level and keep the ball rolling for the portfolio manager versus a typical cash fund, which just is kind of slave to the market flows. So it's a finance type vehicle, but that's to the advantage of our clients. It's very smooth. It's yielding now approximately 397, under 4%. We don't take a lot of risk. It's just an extended out 90 days, maybe 120 type day portfolio. And we typically hold everything we buy to maturity. So we're not in there trading your cash collateral investments. It's just buy and hold, let it mature off, buy something else. Regarding your portfolio, we do a split of the revenue with you. So you have a 70-30 split with State Street, where 70 cents on every dollar we make goes to the plan, 30 cents goes to State Street for the service. It is indemnified, so effectively what that means is if we lend a security to a broker and that broker becomes insolvent, you're going to be fully indemnified. We'll take the collateral, go out in the market, buy that exact same security to deliver it to you. If the market's trading wildly and there's a shortfall on how much collateral, State Street steps in and pays the difference. So the indemnity is there. You should never take a hit if a broker goes under regarding that indemnity, and that's backed by State Street's balance sheet. We're a AA minus rated entity as a credit. So we're also a GSIP. So we're at the table, a group of 10 with all the biggest investment banks as well because of our role in the markets. Performance, I'll just move ahead now. 2023 was the high point in the last 5 years. That's when the markets were rolling. As we kind of came into 24, things started to change. We had more volatility, Fed activity. We still are very consistent. You can see by the number, the second line down on the 2025 number, $114 million is what we average from market value of positions on loan. I just took a quick sneak peek and I saw that right now we have approximately 500 positions on loan. It doesn't mean it's 100% of every position. If you have 5,000 shares of Google, we might loan 500 of them because they'll be packaged with other clients' Google. We have an algorithm that applies to our whole program that makes everything equal. So you're no different than the largest funds or the smallest funds in our program. And it's all calculated daily and reset based on availability and market value of what's on loan. So it gives everybody their equal shot. Something's available and the Goldman's coming in, they want to borrow Google. It'll just line up everybody that's now risen up to the top of the queue and fill it. You didn't get filled, you're going to be at the top of the next loan that's you're eligible for. That's been in effect for many years. State Street's been in the business for 52. We're one of the oldest securities lending agents out there. We've matured and evolved with the market accordingly. All the great upheavals in the market, from the tech.com bust to 9/11 to the 08 market crash to the global pandemic, we've kind of gotten through. Rarely has there been a true loss on the product. I will say after 08, some of the cash collateral in some of our vehicles took a while to collect. And by a while, I mean a couple of years. But at the end of the day, everybody got out at par and they were still making revenue as the trading was going along year after year. So it kind of has strong legs in the market. People obviously short positions, not just straight bets against the positions, they hedge. And more the evolution of the product is financing the broker dealers. Everything's become a type of financing balance sheet game. That's just directly correlated to the different rules in Washington that came about from Dodd-Frank. So we do an intricate dance every quarter with the broker dealers and their balance sheet management. And we do some of the management on our own balance sheet too. You know, what do we want for balances? Indemnity costs our balance sheet money. So it's an intricate dance, but it's not as if it's a big ebb and flow. It's worked out over the years, so it's fairly smooth to the eyes, but I'm just telling you a little behind the curtain with our trading desks. We start lining up quarter ends, you know, 4 or 6 weeks in advance. Who needs money? They're going to be there if we need money, et cetera, et cetera. So it's a very much an interactive marketplace. I would say evolving marketplace. We have, I'm going to say 90% of your equities are put out every day automatically. Files start hitting at 4 or 5 in the morning. Brokers send in, I want these 10,000 securities. It's a generic rate, more or less, that we post every night. And that's just for the securities like a Google. You can borrow it from anybody. So there's no need to auction it. For any positions that are auctionable, we remove that from the overnight and we start the auction process calling positive, being proactive. And we'll say, hey, I have this, I have that. Do you want to hit me on a rate? Treasuries are traded that way every day manually. And that goes across the entire portfolio for sovereign debt as well over in our EMA markets. No surprise on this next page. It was referenced, you know, your small cap fund makes you the most money. Those are those special equities that are not simply put out for a flat rate. Those are the ones we actually get to negotiate back and forth with the brokers. They try and get it as cheap as possible. We try and make it as expensive as possible. It's a very traditional negotiation there. Your Wellington portfolio and Dodge and Cox have some of your treasuries. I was listening to earlier comments about treasury market. You know, the explosive growth of the treasuries being issued to support the government at first started to stifle our trading, but then with some volatility added in, it's worked out okay in certain circumstances. And by volatility, it's more or less the Trump administration coming in last year stirred up the markets. As you might remember, we had Liberation Day in April, which caused the markets to go haywire, and then it settled back down. And now we have geopolitical turmoil a little bit, but you know, extreme volatility nobody wants. A little volatility, that's what New York and traders live for. You know, they try and get the best rates. We're no different. That's what our trading desk wants to do at the end of the day. Top 10 securities. You'll see there are several treasuries listed there. I see a favorite among many clients, Lucid Group. That's just the classic anti-electric car vote. You know, go short a green company. Lucid's been on everybody's boards for the last 3 years. It's a kind of a perpetual directional short. It's making you $48 a day from having it on loan. As I said, we deal in basis points, but it's accumulation over time. The top name, Nexbridge Hydrocarbon, that was a spinoff and a corporate action reorganization. The second reorganization was done, it went into receivership. So it's one penny.
I have a question here.
Oh, sorry.
Yeah, quick question.
Yep.
Can you talk a little bit more to the indemnification process?
Sure.
Particularly when, you know, should markets freeze, if you will, for a period of time. I do remember 08, 09.
Yep.
No one was trusting anyone. And so there are moments when that happens. Hope it doesn't happen again. But in that indemnification process, can you describe a bit more what that looks like and the implications for us?
Sure. So our indemnification is meant to support and buffer any exposure you may have for a borrower to go insolvent. Back in 08, 09, we were fully indemnifying our clients, but the fact is we didn't have to do it because the markets, what happens is you have high quality short-term collateral, cash, treasuries, agencies for the most part, and the equity markets don't rally on that news. You know, Lehman went under, they plummeted. We had more than excess collateral. What we do is we go in the market, we buy those securities, hand them over to you. You're out now. You've got your securities back. Excess collateral, we send back to that borrower, but only after we make all our clients whole. If there's a shortfall, and that's the key, if, that's when State Street has to open up its wallet and pay that difference. Now we have some different agreements with brokers about that, meaning, you know, well, you're not going to get all this collateral for Google if our Microsoft shares, you know, we're short there. So we're going to apply it over here before we send you anything. But that's a agreement between State Street and the street. But for client purposes, we're going to go in the market and buy whatever security that never returned from loan to make you whole, and it'll be at that market cost. And if it's not full price, then we pay.
Thank you.
John, quick question.
Sure.
If I understand this right, like 10% of the gain last year, $300,000 was from one stock.
That's correct.
In the DFA fund. Do you have any sense of we're lending people our shares? How often are they using that to short the market? I mean, it feels like that's what's happening most of the time, but maybe not. I mean, it feels like particularly small cap stocks, people want to short them. They want to take our stock, they sell it, it goes down, they buy it back, give it back to us. We take the economic hit. So we're kind of facilitating people selling our equities without us knowing about it. Is that incorrect?
And a short answer, that's correct. And a longer term answer, this is why, you know, pension plans are less concerned about that 1 or 2 month performance. Like a hedge fund's going to come in, hit it, they're out. You know, and they close out their trade. They made some money. Pension plans, you might have a longer term exposure looking at the performance of that stock. So you're going to own it through the peaks and valleys, but you'll own it longer term. And that's why something like lending just buffers you from that valley, unless you're going to sell it immediately. A lot of loans are done for directional purposes, as you referenced, but a lot are done for hedging purposes as well. You know, if they are long the tech industry, they might pick out a handful of names to short just to buffer themselves. And when I say they, a portfolio manager, an alt manager that runs a balanced portfolio. It's a lot of leveraging, but it's also hedging that goes on.
But John, when we lend somebody our shares, most of the time they're selling them. Is that correct? That's why they're borrowing them? They don't, right? They think they want to see that investment go down. They're gonna sell it now, buy it back later.
Yeah, if you yourself want to short a security, you'll call your broker and say, I want to short this. The broker's not going to go in the market and buy it to give it to you.
Of course not.
They come to
Take it
State
from our
Street,
account,
they
right?
borrow, yeah. They would borrow it from us and then deliver it to you, you know, in their private wealth management, and then the short would be delivered. So yes,
Do you
from that
think short
perspective,
selling is a benefit to long-only investors like us?
it does. It provides liquidity to the market. Because if lending went away, the prices would go up because you'd have more sales everywhere. Because brokers rarely fail on the delivery of securities because they can source it and borrow it from so many places.
Thank you.
And to your point of that one stock being 10%, yeah, that stood out to me as well. It's an odd position because it's worth a penny. It doesn't trade, so it's kind of stuck in their portfolio, 15,000 odd shares. But we mark it up to $1, and so we're just charging them a high 99% rate on the borrow. So it's $85 a day in a worthless position, and they can't trade out of it because it's not trading. So it's
But
just
we own it in the portfolio.
you own it in the
We lost
portfolio,
everything on that position.
right? The only thing you can do is
Just to be clear,
yeah,
it was 100% loss for us.
yeah. So it's making $85 a day to you. So until someday down the line where it's going to come out of this receivership and get traded away,
Right. I got
it's this round it, call it $100 to you every day. So that's a weird scenario. Most of them are more like Lucid, where it's a directional. But you know, the company. My favorite all time story, and I'll just share this quickly. Where it was a few years ago with Tesla, and you may recall it was before Tesla became Tesla. They were on their way. The market had a lot of alternative funds coming in to short Tesla. And you had, I said, it was the church of the believers, the church of Elon Musk at the time, investors, versus the non-believers, the hedge funds. And the hedge funds couldn't get enough of it. So we priced it all up accordingly, because the more that borrowers want it, the higher the auction can go for what it costs to borrow. So we had high rates on it. And sure enough, in March and April, and they were all gearing towards this June date, boom, it hits June. Tesla blows the numbers out of the water. Now it's a giant short coverage. They got to turn around and buy it all back, and the market value goes up. So now your position went up 50% on your long position, but you've just ridden it for 3 months, making 99% of the value in a stock loan circumstance. A year later, same guys came back. They didn't believe in Tesla and Elon Musk. They bet against him again, and he didn't have the numbers to back it up. But this was the year, some of you might remember, he came out a couple days before the earnings announcement, and he did like a commercial almost like for CNBC and Bloomberg of him selling 5,000 flamethrowers. It had nothing to do with anything. Showed some guys in the desert. He sold them out in 10 minutes, and that's all anyone wanted to talk about. They forgot about the earnings mess. Yeah, I don't look over here. So again, the shorts got beat up with the short coverage. They ran away. So yeah, there are games within games in the marketplace.
Yeah.
Securities lending plays its role, but you're long holders of the security. And if you hold it long and there's a value on the secondary market, we'll seek it out and we'll get you something for it. Typically, a loan of a U.S. equity will last anywhere from 20 to 35 days on the books. It can last 1 or 2 if it's just churning, an easy to get name. But a name where there's something going on, somebody wants it, it'll last about a month. I just put in this top 10 borrowers. State Street also borrows your securities because we have a prime service. So we have a whole list of alternative funds as clientele through our prime service business. So they will come in no different than a Goldman, Morgan, UBS, and borrow securities from the agent program. Collateralized the exact same way. Plus, we have compliance reporting oversight because they can't be the best price on the books or anything like that to avoid any implications of, trickery going on in the booking of it, because we're acting as agent and then we have a product coming in as a principal borrower. But it shows the growth of our prime. I was just told on a call this morning that we're now the number 9 largest prime broker in the marketplace. Our goal is within the next year and a half to be number 6. We're never going to be top 3. That's not our core business, but we're going to try and be 6. We're number 3 from an agent lending perspective, from pure volume. BlackRock's number 1. They don't operate under the same mandates as us, as a federal regulated bank. And Bank of New York and us kind of dance back and forth between 2 and 3 for pure volume and size. Now, for 26, your number 1 borrower is JP Morgan, year to date. So that can fluctuate too, just who's coming in to borrow. And if it's just volume, they might be coming in for more of the treasuries. So we're not a treasury finance. Our prime just borrows some of your equities. But JP Morgan's your largest borrower year to date. Goldman's 2, State Street's 3. I'm not going to bore you with this too much. This is just a quick look at your cash collateral. It's professionally managed with a designated portfolio manager in our sister division, State Street Investment Management. They run a handful of investment portfolios, and the Compass Fund, it's called. You can see up in the left-hand corner, this is a snapshot from December 31st, and there's your 397 on the fund one-day yield, but it's got a very short WAM and a short wall. It's 25% today. It's 25% overnight, 30% weekly liquidity. So it's very liquid right now, and that's just pure reflection of coming into a quarter end with some volatility in the mix beside it. And again, that's one of those, if things smooth out, we might extend it out if the portfolio manager sees some benefit and some additional yield pickup for something short. You might buy a 6-month issue and put it in the fund to pick up a little bit more yield. But very, very stable. It's some fluctuates between 7 and 8.5 billion in size right now. And we have a number of public retirement plans in it. Now, I just, as an FYI, I did put in a slide or 2 in the back for if anyone's kind of unsure about how securities lending works, you can kind of reference that. But effectively, is someone comes into us for your security, we loan it to them. We simultaneously take the collateral. If it's cash, we invest it and we hold it until they return the security, or we recall it back from them. Fully recallable daily. Your portfolio manager sells the position. We can recall the broker, or we'll just sub another client in behind the curtain. You're out, you have your security delivered. Somebody else takes over the loan from that day going forward. So it's somewhat a very smooth process.
Any other questions for John?
Well, thank you very much for your time, and State Street appreciates your business, longstanding partner, and we absolutely recognize that. Thank you.
Thank you.
Thanks.
All right, well, before we move into the 2026 capital market assumptions, take about 10-minute break. calling the meeting back to order. And now we are going to listen to the 2026 Capital Market Assumption and Asset Allocation Review, and welcome Jay Klopfer and Gary Chang along with Jim. Welcome.
Thanks. Gary was ill, so he's just listening in on the call.
Yeah, we decided it would be better not to have him come get us all sick, so
Good idea.
regretfully couldn't be here today. But I think many of you have seen Jay over the years. I think Jay started coming with me in 2000 or something like that, and he's done 4 or 5 asset liability studies and this annual asset allocation review for you. So again, I mentioned this earlier, but you know, the most important decision you make is asset allocation. It's primary determinant of return, but more importantly, risk over the long haul. And again, every 5 years or so, we do a very detailed asset liability study where we take the actuarial valuation and capture the changes that Graham has, the experience that you have from a return standpoint, and also from a demographic standpoint. And we capture all that and look in the future and kind of say what makes sense from an investment portfolio. In the years in between that, we do what we're doing today, which is an asset allocation review. So we're really just going to focus on the asset side primarily today. Every year, as you know, we do forward-looking capital market expectations, and that's what Jay and Gary are going to spend a lot of time talking about today, but these are forward-looking. We try to capture what we think are reasonable outcomes for the various asset classes. So what do we think is going to happen to equities, bonds, et cetera? Not purely just the return, but the range of returns, which is the risk part, right? And frankly, that's the part we have more confidence in than anything. We don't have a great crystal ball. We can't tell you exactly what's going to happen over the next 10 years. There's a lot of good rationale that comes into those assumptions, and that's what Jay and Gary are going to walk through today.
Yep.
But what we're looking at is this set of assumptions together, how asset classes interact with one another. So there's going to be a little education in how all this kind of works and how we put the portfolio together. And then we'll look at your portfolio today, and we'll look at some alternatives for you to think about. Importantly, you don't have to make a decision today. You can. I think that there's an opportunity for you to change what you're doing if you were to be so inclined. You can do that anytime, frankly, but today's the opportunity to discuss this in a fair amount of detail. The other thing we're going to do is we're going to take just a little bit of a closer look, particularly at your public asset classes, so domestic equity, international equity, and fixed income. There's been a number of questions that have come up in past meetings about why do we do that? Why do we have small cap? Why are we overweight small cap? Why do we do this and that? So we'll just explore that in some detail today as to why. And it gives you, again, an opportunity to explore whether you want to implement those exposures any differently than how you're currently implementing the exposures you have to those assets. So this is just an outline of what's going to get covered today. Again, Jay's going to talk about the projections, the process, why we do it, and what we're kind of seeing in the economy now and in the future. How do we build up returns for equities and fixed income and other kind of things, and what it means for your portfolio. So any questions before we launch in? Okay, I know you're not shy, so stop Jay along the way if needed.
Yeah, if you go to slide 4, we will talk about what's going on right now. We try not to let what's going on this week be the tail that wags the long-term projection dog. So bear with me, we'll get to that. For those who I haven't been able to address on this topic, I'll give you a quick update as to why we do this. So we do projections once a year. We start them in September, we release them in December, and they become the ground setting or those table setting for all the work we do with clients on strategic asset allocation. So they're reasonable, that set of expectations for return, for risk, for correlation. And then underneath it, there's a lot of interesting thought that goes into it. What kind of economic outlook do you expect? What are you expecting for inflation? What are you expecting out of interest rates? How does that inform what you do when you set some assumptions? And then how do you think these assumptions will then inform investors? Do you want to make big changes year to year and tell investors, okay, we need you to move your giant portfolio around? It's not really the way we do things. So I think of ourselves as
conservative in the sense we don't make big changes year to year unless it's compelling. And you'll see that's a key element to this year's set of expectations. We also need to understand how they're used. I don't care if these are exactly accurate. Nobody in my group does. It's meant to be guidance. You know, a manager, as Jim mentioned, a manager or a hedge fund, for instance, but even just an economic manager, they're typically 18-month horizon. These are 10 years, knowing the world doesn't end in 10 years. We even have equilibrium projections that go out. So the front end noise, we want to be really careful because we're setting policy for the long term. So we're informed by current market conditions, this last line here, but we don't build, you know, directly off of whatever the valuation is right this moment. And hopefully that'll all come true. If you go to the next slide, please, our beliefs. We do have beliefs. Everybody owns these assumptions. So my group comes up with them, then we take them through our internal review policy, our policy review committee, and then Jim and everybody in the consulting business has to own them, and they do. So they need to talk about them as well. So we have a bias toward long-term average. We have 75 years of really good capital market data, and I've even got some charts that go back to 1790. Why would you ignore it, right? It actually happened. You can then have an opinion about the future. Absolutely perfect. You know, it's good to know it, but you know, a forecast ultimately is an opinion about the future, which is unknowable till it happens. So when everybody gets too wrapped around the axle about the forecast, just keep that in the back of your mind. It's an opinion about the future. I mean, again, I mentioned our conservative bias, not political, conservative in terms of not making change unless we need to. We believe there are risk premiums to be had. You invest in stock because you think it'll do better than bonds. And there's risk that goes with it. We also presume ultimately markets will clear and they'll be rational, but they can go for long periods of time and not be. There's a famous quote, the markets can remain irrational longer than you can remain alive, right? But, or solvent, let's put it that way. Let's be a little nicer about it. So there's all these beliefs that we have in here. What we need underneath all this is a set of assumptions about the economy. We need models about the detailed asset classes, a bond model, an equity model, models for real estate, models for private equity, a path for interest rates and inflation, and then a cohesive outlook. And so that all gets fed into a set of forecasts. What do we forecast? We go to slide 6, major broad asset classes. Frankly, it's really ownership and debt and hiding it under a rock are the 3 main asset classes. Everything else is a derivative thereof. We do acknowledge the hubris to go into, well, US versus non-US, large versus small cap, developed versus emerging, some of the flavors and tenors of fixed income, and then the alternatives, but they're all come back down to, do you own the asset class and share in its capital appreciation? Maybe some of the income it generates in its economic activity, or are you lending money and hoping to get all your money back plus interest? And then you can hide your money and just not invest it. You think of that as like cash equivalents. All right. So I always keep that in the back of my mind. What's the nature of this asset class? Are there hybrids? Absolutely. Think about real estate. Generates a lot of income, but you own the underlying asset. Okay. So that's the components to get forecast. The big reveal is this is one of those years that despite the mayhem in the capital markets, we chose not to change our 10-year forecast. So what happened last year? Not very much, right? We had a new president. We had the announcement of Liberation Day. We had the imposition of tariffs in a, let's just say, variable way across different countries at different times. The markets did not like that uncertainty. And then by about July, all of a sudden went, yeah, we can live with it. That's technical term. Yeah, we can live with it. The equity markets then turned around and had a terrific second half to the year. Fixed income rates came down a little bit, which gave a boost to fixed income. All the asset classes had a great year, and you stack that on top of 10 years. It's been a terrific run to be an investor, to be a long-only investor, especially in all the different markets. As we went through it, like what were we going to address? We think equity, we think fixed income yields, the yield curve, except for the very short end, is about where it's supposed to be. We weren't going to make a change there. Equity is rich, very richly valued. We have what we think is a conservative estimate, still has a premium over stocks, but it's probably one of the bonds, excuse me. Thank you. It's probably one of the narrowest premiums we've had in my forecasting history. So we held cash returns at 3. Actually, let's go to the next slide, please. You can take a look at the eye chart here. Let me walk you through this. Focusing on those 2 shaded columns. The first shaded column is return, and I broke the returns into groups of equity on top, fixed income in the middle, private markets or alternatives in the third box, and then at the bottom, let's start there. So inflation at 2.5. Right now, what is inflation at? 2.4, what it just came in at. It's likely going to be higher in the next year. Tariffs still are going to have an effect. And then, you know, foreshadowing what we're talking about, the price of oil has gone from 70 to 100 and something. And, you know, depending on how long that stays, it could have an inflationary impact. But over 10 years, our expectation is inflation will actually tail down toward 2. So that 2.5 includes higher in the front end, tailing down toward 2 in the longer term. How do we verify some of these forecasts? We do look at other people who forecast like us, other consulting firms. We can get that information. We look at our friends in the investment management business. They have to come up with forecasts. We look at people who forecast for a living and don't have any investments. They have a different perspective. We look at what the government puts out. 2.5 is pretty much right down the middle of consensus over a 10-year period. Even the Fed is in that position. If anything, the Fed's higher than their own stated goal, which is very interesting. Cash then, 3%. That's a 0.5% real return, which is positive. Take your eyes up to the middle of the page. Second line down is core fixed income, which is what you're invested in. You're core plus, but that's the benchmark is core. 475. And then equity up top, let's look at large cap, which is the second line down, 7.25. So that's a premium, 2.5 over bonds, pardon me. But what's the long-term average return for U.S. equity? It's 10. So we're saying you're going to underperform the long-term average. We are going to underperform the long-term average by almost 3% per year for 10 years. I would call that a fairly conservative forecast. Okay. We give a small premium to small cap over large. So then you end up with a broad number that's a little bit higher than that. We give a premium to emerging markets over developed markets. So you get a broad U.S. forecast that's a little bit higher than that 7.25. Then move down to the alternatives. You have real estate, you have private equity, and you're implementing private credit. They all have, it takes a little more skill and art form to come up with expectations for those. We think of real estate as being between stocks and bonds. We think of private equity as our highest returning asset class, but we have a large implementation risk element in there. Not everybody even gets the S&P 500. And it's very expensive. So implementation matters a lot. Private credit, we actually have a return that looks like public equity, but implementation matters there a lot too. So those are our sets of expectations. So 3% for cash, 4.75 for fixed income, 7.25 for large cap U.S. stock, a little bit higher for non-U.S. stock with the emerging market premium. Real estate at 6.25, private equity at 8.5, private credit at 7.25. And we'll show you what that means for your total portfolio. Okay. So that's a set of expectations. Let's talk about the underlying market conditions. Here's where we'll jump in. So what about the Iran? Does that change our opinion on the long term? My opinion is that I've been following this very closely as we go along here. There's two main issues going on right now. One is the constriction of supply, the shutting down of the Strait of Hormuz, where 20% of the world's oil supply comes. And then the impact on the price of oil, which has jumped. Ironically, we are oil exporters as a country, but we're subject to global oil prices. So it doesn't matter that we could self-supply at a lower price. The producers are going to go to market prices. So the price of gasoline has shot up, as everybody has quickly found out. I filled up my car on the weekend. It's now $6 something a gallon in California. What does that mean for inflation? What does that higher inflation mean for interest rate policy, both here and in Europe? And then what does it do to the chances of recession? So that's sort of the thought process behind what's happened in the last 3 weeks. Does it meaningfully change our forecast? No. Why? We always expect a recession in the next 10 years. We just do. It happens every 10 years, sometimes twice in 10 years. We have called for a recession at the beginning of 24, at the beginning of 25, and we stopped doing it at the beginning of 26 because we kept getting it wrong.
Unloved.
Pardon me?
Unloved.
Unloved, yes. It could happen, and it may spur it. I think what you're seeing in the background from some of the data are the job market has definitely softened. GDP has stayed strong. We won't get a first quarter GDP number till April. But some of the data are now not working. And I think what has happened is the pandemic really was a giant shock to global supply and how everything works. And the data that you normally followed so closely doesn't have as much meaning. How do you interpret a 50% drop in GDP followed by a 40%? No meaning. GDP is something that works when the economy is moving slowly and you're measuring tiny little changes over time. What does an inverted yield curve mean? It means rates are higher on the short end compared to the long end because investors expect rates are going to come down. The yield curve has been inverted on the short end for 5 years, no recession. So maybe an inverted yield curve doesn't mean or cause anything anymore. It's just those are investor expectations. The job market is a problem. Getting reporting out of the job market has been a problem. The numbers are moving around a lot, which typically happens when you get to a turning point. And I'll show you a chart on that. So it's, the recession stayed away. The economy showed signs of slowing, but then we had some surprises last year. I'm backed away from calling a recession for this year, although what's happening right now may be sort of the instigator, the triggers that we finally get to it. Does it change a 10-year forecast? I would argue no. It just may move when you get the recession. Okay? So that's where you get to the point here. I realize there's a bunch of words here. The likelihood just keeps getting pushed off. So some macro themes, aside from what's going on in Iran, tariffs still matter. Tariffs are a tax on the sale of imported goods to consumers, businesses, and governments. That is their definition. They are not absorbed by the seller. What they can be absorbed by is the importer, and that's been happening a lot. That's kind of muddied the waters. They can be fully absorbed by the underlying individual. I think some of the challenges have been intermediate goods. Think about the U.S. automaking system. The U.S.-based automakers make cars in Canada and Mexico. They make parts. They buy parts from Canada and Mexico. So it's having a big impact on autos. You combine that with rising prices then for autos and challenges for consumers starting to emerge, and you're seeing some financing issues in autos. Tariffs could have meaningfully increase inflation in the shorter term. Remember now, inflation is a really weird number. It jumps up 9% and then it goes to 0. It's 9% higher forever, right? It's no longer at 9, it's down to 0, or maybe it's at 2, but prices are permanently higher. And we're starting to feel that now. I mean, inflation peaked in 23, I think it was. People are really feeling the pressure. And now you're going to see even more pressure. What does inflation do? Well, it increases the value of some goods. It certainly had a great impact on the stock market in the longer term. Short term, not so good. Not great for bonds because it implies higher interest rates. So inflation can be problematic. What it means for the Fed is they're trying to decide, is the economy slowing down enough that we can cut rates, or is inflation a problem? That's their dual mandate, jobs and inflation. Those are some of the themes. I thought the chart on the next page, Gary and I were looking at this, and one of my other staff members helped put this together, tracking effective tariff rates all the way back to 1790. Remember 1790? But what I really focus on is look at from 1950 forward, nothing above 6 or 7% effective tariff rate. And yet last year we jumped in at 25, 30%, and we've stayed around 18, 20. It cannot not have an impact. Oh, that's terrible language. It's bound to have a problem when it comes to inflation. It hasn't shown up yet. Part of it has been, it took until July, August to really get them set. Things have been changing over time. Implementation has varied. It hasn't, and then, like I said, sometimes importers are just absorbing the cost, assuming maybe they'll go away. So it's unclear to me when the impact from tariffs will hit. Maybe it won't. The idea behind the tariff policy, as articulated by the administration, is try to restart American manufacturing. That doesn't happen overnight. And for some goods, it may not happen. It's certainly happening in places like steel manufacturing. You're seeing giant shoot up in the activity with regards to steel. Where it's more difficult is in, some of the industries, especially technology, that have been offshored for a long time. Anyway, there's your tariff rate discussion. The job market discussion is on the next slide. This looks a little weird, I'm sure, to everybody, but this is something I follow closely. The average number of new jobs per month when we're doing well is between 100 and 200,000. Everything to the left of that red box is between 100 and 200,000. There's a few smaller ones there, and you're looking mid 24 when things slowed down. But we averaged in that range. Since May of last year, the cumulative total was only 93,000. So 1 month's normal rate came in 8 months. We just revised the job market. December is now negative. January was pretty good. February not so. So what's going on? And yet the unemployment rate hasn't shot up. How can that be? How can you no longer be creating jobs and the unemployment rate doesn't shoot up? Foreign-born workers it's been a huge impact on foreign-born workers since April. So there's fewer of them in the economy, fewer of them being counted as unemployed. So we've restricted, supply has shrunk. So we don't have as many new jobs, but there's fewer people demanding. It's been an interesting element to go through. Slide 14 kind of gets you to an idea of, so what have we just been through the last 10 years? Look at that 10-year column. 14.8% for the S&P 500. It's astounding. Non-US stocks have done really well too. It's just they didn't keep up with the S&P. I mean, the World ex-US, which is all the developed markets, 8.5% for 10 years. If you'd told me that 10 years ago, I'd go, wow, look at that. But it didn't even keep up with the S&P, which is up 14.8. If you divide the S&P's return by its volatility, you get something called a Sharpe ratio of 1. That's what hedge funds dream of. So it's been a really tough market to beat. Fixed income's only up 2 on the aggregate, but that includes a complete repricing of the market when we raised rates back to normal. So the fact that it's even positive after 10 years is pretty good. The last year was really great because rates went down a little. And then when you look at the alternatives, real estate, Nareit equity, it's actually down for the quarter. Real estate's had a repricing. NCREIF property, is really what we want to look at. Last 3 years, we've all heard the stories about real estate. Been a complete reshaping of it. I'll show you more in just a minute. But even it's been positive over a 10-year period. And then private equity, what we hope to be the highest returning asset class, couldn't even keep up with the S&P 500. Been an amazing 10-year period. And then just because it's entertaining, look at gold. Up 65% last year. It's up more this year. What is going on with gold? Gold has no economic purpose. It's a price. It doesn't have a purpose, so there's no cash flow. I can't tell you whether or not price is fairly valued. I can't tell you that. I can't come up with an equilibrium price. But I know there's a lot of demand for it, and it's coming a lot from central banks who are looking for an alternative to the U.S. in terms of monetary policy and fiscal policy. So it's an alternative store of value in an uncertain world. And that's typically been its role. Just in the back of your pocket, good cocktail party thing, price of silver is up 220%. Silver actually has some use, but it's been an interesting period in which to look at it. Slide 15 is just a periodic table, as you all have seen in the past. Again, the reason I put this together years ago was to remind people that you try and pick that consistent winner across the top. I dare you. That's pretty tough. You look at from 18 to 25, okay, 8-year run, 7-year run, cash at the top twice, large cap equity at the top 5 times, because that's an 8-year run, then emerging markets. Pretty tough to call from a tactical perspective. So very useful to try to remind ourselves, let's have a little hubris. Let's not have so much hubris here when we're trying to look at the market. Quick summary then of the U.S. economy. Upper left on page 16 is GDP. That number that says projected 1%, it came in at 1.4. So we'd put these charts together before the fourth quarter was cleared. The estimate right now for the first quarter of this year is 2.7. I just checked it, but the range is lower than, like 1.5 all the way up to 4. So we're still not sure what's happening there. See the inflation measures on the right. The Fed follows something that I'm not showing here, which is the personal consumption expenditure deflator. Quite the mouthful. It tends to be about 1% below CPI. The CPI came in at 2.7 for the year. It's down to 2.4. The PCE actually has not come down. So the personal consumption deflator, it's at about 2.7 as well. Interest rates, I think this is really fascinating. Look in the lower left. The dark blue line is where the yield curve was at the end of 2023. That's an inverted yield curve. Rates are higher on the short end, much lower on the long end. The expectation is rates will be cut on the short end, and that will be a boost to and they'll be cut because we're going into recession. It's happened slowly over time. Now the orange line is where we are now. So we've seen the Fed cut interest rates by almost 200 basis points over the last couple of years. Still have a slight inversion there, but the long rates have gone back up, something much more closer to what we think is long-term average or equilibrium. And then you can look at the 10-year yields on the right. And what I find interesting, actually, I'll talk about the break-even rate in another page here. Labor market on the left. On the next page, this is this notion of what's going on in the native-born versus foreign-born. I know those are weird terms, but that's the way they're reported. So you can see the foreign-born labor force in green falling over the course of last year, foreign-born employment level falling over the course of last year. So a reduction in supply.
And Jay, those are, it's legal immigration.
Legal. There's, because illegal, it'd be impossible to have. You could have an estimate of illegal, but I don't have one. The unemployment rate ticking up gradually from just below 4 to a little bit of about 4.4, I think. If I had a much longer history for you here, this is a historically low number. 4.4 is a terrifically low number. Wage growth, it's come back down a little bit. This is average hourly earnings, so it's more on the average hourly earnings scale of things. Still about 4, so that's above inflation. That means real wages have been rising, which is a positive. And then unemployment, there's 2 numbers to look at. Continued claims, which is much higher, so you can see the scale on the right in the millions. Initial claims, which is in the hundreds of thousands on the left. I follow initial claims, and they're reported on a weekly basis, and I look at a 4-week moving average. And the rule of thumb is, as long as they're below 200,000, your economy's in pretty good shape. The challenge I'm seeing here is this gradual rise in continuing claims, meaning it's getting harder to get a job once you become unemployed.
So on the average wage growth, so there's averages and there's medians. So there's been some speculation that all the growth in the economy and so on, or consumption, is being done by a few people at the higher end.
They are.
So I'm just wondering if this wage growth is all due to Elon Musk's pay, or is it more widely?
He would not be
spread?
included in this because this is hourly earnings.
But even
So
among
you'd
the
have to have an hourly job for this to get.
Right, but even among the hourly, is the average meaningful, or has the distribution changed over the years? So it's concentrated.
Within hourly earnings, average still works pretty well, but within total compensation, you're exactly right. It's the distribution has really spread out. So there's exempt and non-exempt workers, right? And there's those who get a salary. I mean, I'm a exempt salary employee, so I would not show up in this number here. Yeah, but you're absolutely right. And there's really been a split. And that's actually one of the arguments for why GDP is doing so well, is that those in the top end of the income distributions have had a tremendous boon to their total compensation through the stock market. Not everybody at the lower end of the income distribution has that same exposure.
When the distribution changes like that over time, does that affect your long-term projections, or
It does.
or is that just minor detail?
No, it impacts it. Part of it too is like we've been gradually bringing down and holding down our longer-term GDP growth for a long time, and it has to do with the underlying forces of demographics. It has to do with productivity. Has to do with pay for those doing the work at the lower end of the income spectrum. So it used to be, it was 2.5 to 3.5 was sort of the expectation for GDP. Now it's more like 2 to 2.5.
Yeah, I read somewhere that the massive investment in data centers and AI has skewed some of those GDP numbers. Do you have
Yes.
any comment on that?
Yeah, I do. I mean, the expectation, I saw a great piece earlier this year on AI about us trying to build a castle against the rest of the world. And it turns out others are doing the same thing. And the number I saw thrown around was 13 trillion in CapEx towards AI. So will it get paid? Will it pay out? It's absolutely been the case. That's what's driving the market. That's why you see that separation from those top 7 stocks. The phrase I saw get used was, I hadn't heard of it before. Now I got it. AI hyperscalers. What's an AI hyperscaler? Well, think of Meta, think of Alphabet, think of Microsoft, people throwing a lot of money in to scale up to try to generate some kind of market advantage AI. And they're buying from each other, and they're buying from NVIDIA, and they're buying from the chip makers overseas.
So Jay, just wanted to get your thoughts, your opinion on this. So, I do believe we have a K-shaped economy on the consumer side. And on the producer side, excuse me, K-shaped economy on both sides, consumers and producers. And if there is an industrial strategy that we have now, it's looking more and more like we're placing a lot of bets on the wealth effect.
Yes.
We're almost in over-reliance on the wealth effect. And, I go back to Keynes when he said that when the capital development of a country becomes a byproduct of the activities of a casino, the job is likely to be ill done. And so I'm wondering how long can we sustain this? Meaning, we know that equity markets are at all-time highs. We established earlier in the meeting that, margin balance is also at virtually all-time highs, at least since 1997. And now we passed some legislation last year on the big budget bill, if you will, that allows a lot of, let's just say, depreciation of capital assets, 100% depreciation off of company balance sheets and income statements for their CapEx. So all of this to me is just kind of juicing the economy. But at some point this has to change. So do we, how should we account for that in terms of the portfolio? Because sustaining this, I think we're running on at least a quarter tank.
How do we do this? We have a return that's 3% below the long-term average with a volatility that's above the long-term. So a muted expected return with a greater variability in what that expected return could look like in terms of equity. I think where I would separate the current situation from, say, the dot-com boom, which is probably the most comparable one, is that these are companies with profits, the earnings, with profits, meaningfully adding to what's going on in economic activity. Whether you think there's too much or they're over-investing is an excellent question, but it's not Pets.com.
I agree with you, but I think the concentration, at some point you also want a competitive, diversified portfolio of industries for a nation, not just a diversified portfolio of companies with which we own for our members. But even in the concentration of industries where there's been a lot of investing and incentives created for that investment, you're leaving out a whole bunch of other.
Well, I think the idea there is right now, the way I liken it to is that, who's making the money right now in AI? It's people providing the picks and the shovels, right? At some point, someone has to use the AI, and then that'll be applied to their business, and perhaps it has an impact on productivity or how they can operate and what their margins might look like. So, you go back 5 years ago, a little bit further, when Bitcoin was coming around, it wasn't Bitcoin that was of interest, it's the blockchain. And the blockchain has transformed underlying accounting, especially in our industry. Talk to any asset manager, blockchain dominates what they do in the background. Then take it back, further. What about the internet? When the internet came on, Pets.com was just, a funny meme, but the internet itself transformed things 20 years ago. So I'd look more back like there. How is it going to transform how we operate moving forward? Right? I think it's positive. I think that right now, perhaps there's overinvestment. It's also not evenly spread. It tends to be here, not overseas. If you take the Magnificent Seven out, we look not as good as, well, we didn't even beat the European markets the last few years, right? But it looks even less appealing. And it's also changed the nature of how the US stock market works. There used to be 8,500 stocks in the US stock market. Now there's 3,750. What's going on? Right? There's a different path, either through private equity or more likely through the aggregators, through the AI hyperscalers, whatever you want to call them. The exit strategy now is to go into a public company, not go public. So yeah, I don't know if that's answered every one of your question, but that's kind of like a why is there air question. I can come up with a lot of good answers. I don't know how many of them apply.
Jay, with GNP, it's still consumption, investment,
Yeah.
government, and then some little things. Has that, it used to be mostly consumption. I assume
It
still is.
still is.
Yeah.
About
But
70%.
have those components meaningfully changed?
No, there's
Still about
consumption is
10?
still 70%. Now, consumption includes both business and consumer and government. But the C plus I plus G, and then the one that gets thrown off, just to be clear, everyone announces, well, imports went down, so that means GDP went up. That's impossible. Gross domestic product is domestic production. Imports built somewhere else has no impact on GDP. So just keep that in the back of your mind. Even the BEA puts that out incorrectly. All right. Now, eventually it has an impact. If I buy a car made in Germany, that means I didn't buy an American make. All right. Today in the measurement doesn't show up. Eventually it does. Okay. If you go to the next one, Jim, here's what the Fed is thinking, which is, you go to the next slide, Jim. Next one. Yeah. Yeah. Next one. Sorry. Dot plot. What's interesting here is this is the most powerful and least scientific forecasting tool available for the world. It's a whiteboard, and everybody on the FOMC gets a red dot. And they get to walk up and say, where do they think short rates will be the next 4 years and longer term? What normally this chart looks like is you see the conglomeration on the left? That's what usually happens on the right. Not happen. So there's a huge variation, 2.5 to 4% variation of where folks on the FOMC think interest rates will be. And I think underneath that is expectations and concerns about inflation. So that median is actually 2.9 right now, or 3, I should say. But really the bias is toward higher rates. So that is a very interesting development. In terms of where interest rates are, if you go to the next slide, this is from our friends at JP Morgan. This is the actual Fed funds rate. You can see our 2 episodes of zero interest rate policy, the long one after the GFC, the shorter one after the pandemic. And then the way to trace those funny little numbers there is that the light blue 3% to the right is the FOMC long run projection. Market's actually pretty close. In fact, the market doesn't even think we're going to quite get there. That's pretty interesting. Inflation is on the next page. These are both calculations you can do when you play with the numbers. One is, if I'm an investor, what level of inflation am I indifferent as to whether I buy real bonds or nominal bonds? So TIPS versus just nominal bonds. That's the 10-year break even. Right now it's just right around 2.25. 5-year forward takes all the noise out of the first 5 years and does another calculation. Forward numbers. They're both below 2.5. So we're not alone with an expectation of 2.5. I always love 22 because it helps remind us what the last 10 years have really looked like. So this is returns in 10-year increments for the S&P 500, well, the U.S. stock market, since it goes back to way back to my old neighborhood of 1790, in reverse date order. So the most recent on top. A couple things I draw from it. 1, kind of looks like a normal distribution. 2, it's skewed to the positive. You typically get paid for holding stock. You can see where 0 is. 3, look at that range of returns for the last, the ones I highlighted in blue here. And then also look at 2018 and 2022. So from 2022, minus 18.1 to 2023, plus 26.3. What it means to take on capital market risk. You don't want to take on capital market risk? Don't invest in the stock market. But That's what you could invest on a year by year. That's what you could expect on a year by year basis. Very volatile. And then market volatility and context. This one had more meaning a little bit earlier this year. We're trying to show when there was a spike last year. It's still relatively small compared to what happened. So the spike towards the right, yeah, you know what I get. Yeah, that would be last spring. Okay, let's move along from there. So that's the economic backdrop. Let's talk about the bond market. If we go actually to not this page, but the next one, it's actually more meaningful and we can come back. This is our expectation for what the yield curve will look like now, 3 years, 5 years, and 10 years out. So the yield curve this is treasuries. What do you get for different points of maturity? So starting yield is we use two different colors of blue, but it's the one that's the highest on the left. So we think short rates will come down toward 3 in line with the Fed's policy target. We think those rates between 5 and 10 will nudge up a little bit. By year 10, you'll have that green shaped upward sloping yield curve. And we think that's pretty reasonable given what we've seen. If you take that and go back a page, sorry, Jim, let's just look at the part of the table that says aggregate. And we can follow through how we build a bond portfolio. So there's the income return, which is the current yield, capital gain or loss as yields change. If rates go up just a little bit, there'll be a little bit of a loss in the middle part. Is there any credit defaults? And then when you have an upward sloping curve, as maturities or as bonds mature, you roll down the curve and you get what we call a roll return. So we end up with a result that's 475 for the aggregate. It's, excuse me, the same number that we used for last year. You can see the other components of the yield curve or the other components of the bond market in here. Your focus is on the aggregate, although we'll talk later when you have core plus managers, so they do invest in high yield. They do invest more in credit. Jay, we have a question. Oh, yes.
I want to push a little harder
Sure.
for noble purposes, though, because I'm seeing things a little different. So we have, by some estimates, anywhere between 38 to 40, low 42, 43% of our government bonds are held by investors outside of the United States. Big chunk. And I hope this doesn't happen, but I'm just curious, should you start seeing any foreign investors start dumping treasuries? That would increase the yield and increase the likelihood of that scenario, in your opinion. You've been doing this for a long time, Jay. I didn't expect the fact that you've been looking at this data for years, if not decades. But, geopolitics being what it is, economic uncertainty and geopolitical uncertainty, capital flow can be weaponized, as we know. And so the likelihood of that happening going forward, your thoughts, and should we be thinking about our fixed income strategy not only for the United States, but also internationally a little differently than we have been, say, the last 40 years, in tremendous prosperity in the United States and in the West. So just your thoughts on that.
Adding into that, the current state of the government spending and deficits, and obviously we haven't seen what the effect of the war is, but it's not good.
No, right. Yeah. So it's something we worry about all the time, and we've looked at this question endlessly. I come at it from a different perspective. If somebody decides to dump treasuries, what are they going to buy instead? And the short list is awful.
But is it? Because there are other governments that have gotten, let's just say, their fiscal houses in order, are looking more favorable, even though they don't have the long established track records that we do. But we're at that moment where this
right. But I'd also conversation. Okay, fair enough. But I'd also look at capacity. How much can you invest in those countries? We also tend to blur things by giving groups of countries nice names. Okay, emerging markets sounds great. And then somebody goes, well, emerging markets are fine as long as I don't invest in Russia, Brazil, India, China. Well, that's kind of the emerging markets, right? What is the euro? Well, it's Italy and Germany and France. And would you pick one of those? Would you invest in Russian bonds? Probably not. Would you invest in the UK? Maybe. There's not only so many. Canada's a tiny little sliver. Your opportunities, your outside opportunity set is
Yeah, I mean, and from
bifurcated.
an interest rate standpoint, I mean, the US is still very attractive. I mean, otherwise you're going into markets where you have a lot of credit risk.
Right.
Yeah.
And so it's a trade-off.
The question really is, are we at an inflection point where the interest rate risk in the United States is morphing into a credit risk?
I don't think so.
No?
No. I mean, yeah, the other irony is, our level of debt percent of GDP keeps climbing,
Yes.
but we're still vastly lower than anybody else. So the infamous phrase from a guy who used to be in our business was, we're the cleanest dirty shirt. Which is not comfort. I'm not
Right.
trying to
No,
say
no,
that's
I-
comfort.
I mean, it's a risk. It's
Yep.
worth monitoring.
It is.
It's just, it seems a low probability that there's anything especially in the visible near term, that's like gonna really ratchet it.
Right.
The other thing you have to understand about fixed income too is that if you get a sell-off, prices go down, rates go up, then all of a sudden you start compounding the higher rates.
Right.
Over a long period of time for an investor. So there's short-term pain, longer-term pain. So there's those kind of trades.
Right.
And, it's also, I would just we'll talk more about fixed income. It's one of the main reasons that while we model the aggregate, because it is the benchmark and it is the opportunity set, it's really, technical term, it's a really crappy benchmark. And active managers, consistently can beat it. Good active managers. And one of the reasons they beat it is because they underweight the US government. And so the actual exposure you get through an actively managed portfolio to treasuries is much lower than what the benchmark looks like too.
I think the parallel or the corollary to this discussion is the dollar. So there's concern about the dollar, and the dollar's fallen in value in this last year, which helps non-US investments, right? But is there really an alternative to the dollar? That's, I think, where you've seen the increase in gold. Okay. Let's move on to equity. Talk about equity. If you go to slide 30 is a good one. How do we do equity? What's interesting is equity is a bigger part of everyone's portfolio. It's a much squishier model because there's so many parts moving around. Bonds are math. You can figure out the math, starting yield, duration, everything like that. Equity there's a lot going on. So this is a simplified version. Capital appreciation can come from earnings growth or inflation. Income can come from a dividend yield or companies buying back their own stock. And then whether or not you have a valuation adjustment. So the way we look at it, the first thing, real earnings growth, we link it to the GDP growth. There's no model that shows it's a good match, but we think fundamentally it is. Equity is, the body upon which equity grows is the economy. You can't get bigger than the economy, right? We have GDP growth at around 2.5% per year. You add 2.5% inflation, you get a capital appreciation element of pi. Income. Interesting, dividend yields have come down, and it's a big change. Dividend yield was 2% forever for the S&P 500. It's not. More like 1.5. What happened?
Is that because the S&P went up so much, or is it because,
It's who's paying the dividends. It used to be dividends were, big dividend players were financials, were utilities, some manufacturing firms. Well, tech companies don't like dividends. And that's what's been leading the chart.
Jay, don't you have the ebbs and flows in dividends as a source of total return
You-
over decades?
You do, but it's changed dramatically since 2019, and it came down and it won't go back.
Well, and the other factor too is if you're a CEO or CFO of a company, you can, whatever you earn, you can say, I can give this back to a shareholder, or I
Right.
can reinvest it.
Right.
You can buy your own shares back at a higher
Yep.
rate of return. That's what you're going to do. And that's why tech companies haven't been doing it, because it's been accretive for them to buy their own shares, which is why there's the buyback.
Right. Yep, exactly. And then the valuation adjustment, we have a negative valuation adjustment just for the US market. It's small, and I'll show you where it fits in. But we turn that on and off. It's not, I mean, actually, let's go to the next slide and I can show you how this all works out for the four major asset classes within equity that we forecast. Let's then look at large cap equity. Dividend yield 1.5. I had it at 2 for decades. I finally gave up. It's now 1.5. The buyback yield at 1%. The actual yield for the last few years has been like 4, but we're not projecting that going forward. Buyback yield will go to 0. And in some cases, if you look at the emerging markets, it's negative. How do you get a negative buyback yield? You dilute. You issue a lot of stock and you dilute everything. Inflation at 2.5, real earnings growth, valuation adjustment, we pencil out to 7.25 for large cap. For small cap, we have a even smaller dividend yield, a smaller net buyback yield, but we have a higher earnings growth expectation and no valuation adjustment. For non-US equity, we try to think of large cap as large cap, but there's a different path to it. In developed markets, much higher dividend yield. It's been the case historically, and it still is the case now. Much lower buyback yield, a little bit lower inflation overseas, although what's happening right now may have an impact on Europe, that's for sure. Lower growth in earnings, no valuation adjustment, we still get to 7.25. So we can make, if you have a problem with a 7.25, okay, tell me which one of these components you don't agree with, and we can talk it through. We think it tends to work pretty well. The premium that I spoke of is on the next page. I won't kill it. It's just this is our forecast premium over the aggregate for equities. It's pretty low. Long-term history is like 4.5.
Yeah, this is pretty powerful and pretty important, right?
Right.
Because, as an investor, to get a little incremental return in equity risk, which is a lot higher, that, you're taking on a lot of risk to get just a little extra return. That's the big take from being in.
In terms of, so the valuation estimate, so this is through December. It's changed a little bit since then, but actually it's come down a little bit because we've had not much in the way of return year to date after the last couple of weeks. But the way to look at this is the forward-looking price to earnings ratio. Forward-looking means analysts, forward-looking accounts. Price to earnings is a really good metric of valuation. The green line in the middle is the 30-year average. So the 30-year forward-looking PE is 17. And you can see the latest measure in that table, it's at 22. Shiller's PE gets in, it tends to be, it looks over the last 10 years. It looks at actual earnings over the last 10 years. So it looks like much higher. We're at, 30-year average there is a higher number, but we're much more above it. The dividend yield a lot below the 2%. Again, that's typically a measure we look at. But as you look through this, so one standard deviation above and below are the dotted lines. At December, we're at 22. A couple of things to note. One, kind of a little bit below the peak we got into 2020. It's also still far below where we got with the dot-com bubble, right? What does our 25 basis point valuation adjustment do? It doesn't bring us back to the long-term average, but trying to tuck us back under that one standard deviation event. If you wanted me to have an adjustment that got the U.S. equity market back to the long-term average over the next 10 years, you'd be looking at returns in the low single digits. I just don't think that's feasible.
Do you remember what the number is to take out MAG 7?
It's about 16.
So close to the long-term average.
Yep.
So again, just another example of how those stocks really skew.
But these are excellent things to follow on a regular basis. Oh, okay. Now I see what we're filling in. So now what about the other parts of the economy? I'll go through these quickly. Small cap, not nearly as overvalued. This is compared to its own long-term average. Flip ahead again, non-US. Interestingly, emerging markets is starting to look a little rich. It's had a tremendous run again. It's up 34% last year. And developed markets, not quite at one standard deviation. So everything is expensive, the US most expensive, but the rest of the world's not that cheap anymore. Keep that in mind. And then you can see the dividend yields, the change to the US dividend yield, the permanent ones. They're the blue one down at the bottom. It has come down and stayed low. And I was arguing it's got to come back. It's got to come back. Now I'm not so sure. All right, let's walk through some of the private markets and then we'll get to your portfolio. The way to look at this chart is I'm showing you our projections for real estate last year and this year. They're the same. And I'm just trying to put them in perspective compared to stocks and bonds. So again, we think of the return between stocks and bonds. Okay. If you go to the next slide, you can see the modeling that we use. Cap rates have changed a lot. They finally come up. Cap rates matter. What's also changed a lot is you can see the components that we forecast within real estate. Office is still, pretty weak in terms of appreciation. It seems to have hit a bottom. Also, office has come way down in terms of share, from like 30 something to like below 20. So if you take the combination of all these pieces and you look on the left, you can see how we get to return. So an income return, unlevered, an appreciation, unlevered, and a total return before leverage.
So why is it the commercial, I mean, is this that everyone's gotten out of it?
For which?
Commercial real estate, is it?
They haven't gotten out of it. No, the office real estate, it's been
That's what I mean by
so
gotten out.
massively revalued that its share of total
Oh,
has
it's just-
gone way down.
It's the same amount, but it's just less value.
Correct.
Okay.
Correct.
got it.
Correct. And there's been a lot of managers, we talked to a lot of managers about what do you do with that? Do you repurpose the office space?
Good luck.
Right, that's the answer. That's the answer.
But
If you give them the building, they can do it. Sorry.
But no, it's just, but it has the nature, and we've talked quite a bit about this because we've had, issues with UBS, and so we've gone over this, but it's the composition of the market is very different. Offices, when it was 35%, is a much riskier index, I would argue, just because it is so much more economically sensitive. Industrials and apartments historically have tended to be a little more of a ballast. Retail, office, much more correlated to the economy. Industrial is starting to become a little more correlated just because there's been a massive Amazon effect there we've talked about, right? So that's gone up a little bit. Retail has completely changed in what it looks like. The big mall thing, it's gone away. And so there's been a big reconstitution of the real estate market relative to what it looked like 10 years ago. As for an investor looking forward to.
One thing that we probably don't capture in here as well as we could is what about AI? Because the demand for energy, incredible. And as the price of that energy is now shooting up, how's that going to rebound? How's that going to sort of get rectified? Not quite sure there. Let's talk about private equity. You don't have private infrastructure in the portfolio, I believe. So let's talk to private equity. We do still see tremendous disparity between the best and the worst performers. Like by tremendous, I mean 60% differences in returns, plus 40, minus 20 over a 10-year period. It's astounding. So implementation matters a lot. So when we develop our expectation there of 8.5%, we have a very high risk number, and that's implying the implementation. The actual modeling, if you turn to the next slide, something newer that we've built in over the last couple of years. I think this is pretty useful because now we can argue about the different pieces if you so believe it. So what is private equity? Typically smaller companies. So let's start, we've had people come to us like, how could you have this volatility for private equity? It only gets marked to market annually, but it can go down a lot. So first of all, what are you buying? Small companies. What's the most volatile asset class? Small company. And it's levered. So you should intuitively be coming up with a risk that's that high. Now, if you walk through this here, you have a small cap return. You have an illiquidity premium, a private illiquidity premium. You have incremental debt to equity, a levered gross return, fees and expense, and we come up with 8.5. So we can argue about any of those particular pieces, but we find this to be a very useful construct for putting this together. You don't think you're going to be paying a lot of fees? You can shrink that orange part. You can argue for a higher private equity and illiquidity premium easily. Looking at recent history, it hasn't beat the S&P 500. And there's a lot of money sitting on the sidelines. So private equity is still our highest performing asset class. Still what we think of as a long-term access to companies you probably can't get at through the private market or public markets. So we still like it. And then private credit is on the next page. As a new asset class for you. So we start again with a model where we have an unlevered yield. We apply leverage. We have a levered yield. We have a loss ratio. And we come up with a net individual period return, and then we compound it. And so that return is the same as equity. The risk is different. And it's all about implementation.
Why don't you have a fee thing in this one?
I think we do. I don't remember where we buried it in there. Sorry, I'll get that data for you. These are net of fee returns.
But
I think it's in the levered yield. That makes more sense to me. Yeah, thanks. Good point.
oh, it's probably in the unlevered view.
I have a question regarding
Yeah.
the private markets, and maybe Cost will address it later on too. Jay, both in private equity and private credit over the years definitely has moved from, let's just say financial engineering and a lot of research that I've done, it's improved now company operations, improving operational effectiveness, quality, competitive advantages of companies. And so back to fundamentals, actually what the old leverage buyout model used to be 40 years ago. How are they doing that in your estimation today? How are they moving now away from using financial engineering and spreadsheet tricks and such, and now moving into just going back to just blocking and tackling?
So is this your question to specific to private equity?
Mostly private equity, because private credit is still a little early in that game, but yes, private equity.
I mean, my response to that would be that I think that's probably still going on for certain types of private equity managers and funds, particularly in the large and mega buyout world, where there's a much bigger companies and transactions where there's leverage going on, and maybe some of that's going on. I think in the smaller and mid-market buyout area, not to say that there isn't stuff going on there, but I think what we find compelling, and what we look for when we're looking at for managers and GPs there is value creation that aren't relying just the leverage story to produce the return, but rather that there's some value creation that is, a growth story, a restructuring story, whatever it may be, story that the general partner is going to go in and unlock that value. And I think your managers, I think Abbott, Pathway, are focused on that consistently as well. Not to say that it's still not, the leverage story is still not part of what's going on. But again, I think this is one of the risks, and just my current pet peeve is private equity and private credit get discussed in the press on a daily basis and in our world as a very generic thing. And as Jay said, they are not. They are anything but. Okay. So we have to come up with an assumption for private credit.
Yeah.
It's such a vast universe of things right now. So the point of that being is that you can't really separate the strategy from the implementation. The only reason you're going to do it is because you feel you can implement it in an effective way. If you didn't think if you had to just buy the markets blindly without being able to go in with some discretion, then it become a much less compelling argument to invest in the generic of these asset classes. They're not generic.
Yeah, when you see these huge spreads of results, I guess the lessons I see is better know you better be committed. You better know what you're doing. You need to understand that you can't just buy the market. And if you don't feel like you can do a really good job on it, just don't. Also, the people throw around the term private equity, private credit as if they're the same thing. They couldn't be more different. Private credit loans to private equity, right? All right, let's jump ahead to your portfolio. So Jim, if we want to move all the way up to page 51. 50, let's start with 50. Yeah. One of the views I like to place on top of asset allocation is not just stocks versus bonds versus private markets, but what's the purpose? And to me, this helps a lot because if you look on growth side there's some fixed income in growth. High yield, emerging debt, bank loans, long credit, private debt. They're all growth-oriented investments. Real assets, they include equity, but they also include real estate, other investments. And if you're really worried about the short term, you can buy inflation linked short-term debt or commodity. Diversifying assets, these are, you don't have any in there. Or I guess you are, so a lot of your real assets are diversifying. And when some could argue private credit, private equity are some diversifying assets. And then there's risk mitigation. What are you concerned about? Short-term, generating income, longer-term risk rate protection. So I like this overview. It really helps get a feel for why do I have what I have and what am I going to fund a new asset class from? Right? And we went through this discussion last year. As you consider private credit, what are you going to fund it from? Well, you unwound the private or the public real asset portfolio and put 5% private credit, 2% back in the equity.
And I think that an important takeaway for you on this particular slide, as I see it, and again, you could take some of what's in real assets and put it in growth.
Mhm.
Frank REITs, there's really small cap equities, and real estate has kind of a equity and fixed component, certainly is real. So you could make the argument that growth is even higher, but this is a long-term growth oriented portfolio. It's pretty aggressive. Right?
Mhm.
It's not as balanced, historically there was always 60-40 is kind of the balanced portfolio. This is tilted a lot more towards growth than it is the balance. It's worked well for Marin for the last 25 years. It's certainly been a factor to get you to your funded status position now, not the only by any means, but it's there. That's an important consideration as you hear the rest of this. It's worked. Do you need to be as aggressive? Maybe, maybe not. But someone says, "How's your portfolio?" It's a long-term growth-oriented portfolio.
Right. You can see we put the numbers on the bottom of each column, 69% in growth assets, 8% in real, which are arguably growth assets, and 23% risk mitigation.
Administrator Wickham, given our funded status and given the low population growth that we have here in Marin, does it make sense to start thinking about a more balanced, less aggressive portfolio? We've had the market tailwinds, which work, Jim says, work in our favor. But given those two other components, we do have pretty high funded ratio status. But the offset is population growth here, not as aggressive as definitely our portfolio.
So I think that I'm not going to try to
Yeah.
tell you how you should.
Sure,
invest
no.
in the
I just wanted to get your
portfolio.
thoughts. Yeah.
My thoughts are that you will always need growth because you're always going to have benefits to pay. So this is not, it's not a closed plan. It's an open plan. It may become an open plan that is a more mature plan as it goes on because of the growth aspect that you point out. So we will become more mature. Liquidity will become more of a question, but it is not right. And so you have time to work through the question that you've posed. Your funded status is healthy. I think that's positive. You're going to hear from your actuary here in about a month or two about what happens as you approach fully funded status, and that will have components of your portfolio that he will discuss because those are options that you can think about, taking some risk off the table, dealing with your discount rate. There's all sorts of things you can do with that. But there's not anything today in asking me that question that I think you would do differently because you are a long-term investor. You're going to have to continue to have growth, the level of which is something you discuss with your consultant. And I think Jim teed that up, that it could be okay, it could change.
Does the population growth of Marin come into, is it a factor at all?
It is a factor because because our membership growth is very slow because this is a pretty much slow growth county. So governments are not growing.
But that's just a factor of that contributes to the liability, right?
The fact that it's not growing means you're not adding new people to help pay off to pay contributions towards the funding. So we're putting more money out than we are bringing in for contributions. That's what that means.
but each person that we bring in, starts off at a number and our actuary factors that
Okay,
in.
so before you go on,
Yeah.
let me remind you, what does the employee and the employer combined together contribute towards the dollar that we have to pay?
Very low.
0.33.
Right.
So where does the
So-
other 67% come from? Right here.
Right.
So you've got to have growth aspect to it.
I understand, but my question is I don't think that the population growth of Marin.
Not Marin's population.
Right,
The growth of the governments in our plan.
right.
They don't grow as much as some of your counties around. They are not adding more employees. It's
Right,
more-
that's my point, is that.
Yes,
is-
it's
is-
not
is that
Marin's
that's not-
population
That's not a
growth.
factor.
It's the sponsors don't grow as fast as you would have other government sponsors in the Bay Area who have growth because they have growth in their population growth in their counties, right? That's the factor that the actuary talks to you about is you just don't add new members because your governments don't grow because your population doesn't.
The set of asset classes in your portfolio, here's the assumption. So instead of that big giant table, here's what we boil it down to for you. So you can see the large US and non-US stocks, fixed income, private equity, private credit, real estate, and then cash. The changes. So you no longer have a public real asset portfolio. The assets were redistributed, as I mentioned, 5% target to private credit, 2% target to equity. And then the real estate portfolio does have a custom assumption. It's 90% core, 10% REITs. It reflects what's going on underneath. So if we turn to the next slide, no, 2 slides, excuse me. We can look at what the portfolio looks like. So you have this approval on the right side, the approved portfolio. What's the difference in the return between last year and this year? Is this very modest change in the portfolio in terms of 2% more in broad U.S. equity. We don't have the public real assets anymore, and we have a 5% private credit exposure. Fixed income is the same. The expected 10-year return compounded is 7.3 compared to 7.2, a little bit more equity, and 13.1% risk compared to 12.9. So it's a small change, and it results in a small change in the expected return and risk. You want to translate to a picture that makes it a little more meaningful, go to the next slide, and we take the current policy target and we simulate results. Now, remember I showed you the chart with that looks like a normal distribution, and you have the giant year-to-year changes. That's the first year. That's what you can have. You can simulate what happens in our first year. You could have something as high as a 35% return, something as bad as a minus 15% return. It's kind of in line with history. Over time, good years offset bad years. Now, this is returns. It doesn't attach dollars to it yet. And you get out there to 10 years and you have a range around that 7.3 that's as high as 15 and as low as 0.3. Okay? And then I also put in here your discount rate, which the actuary uses, which is 675. And then I calculated what's the probability you beat that. Now, at first, sometimes people will look and go, 56%, why is it not higher? Well, this is the midpoint of a distribution. 50% is really good. But more than half the results get it. This is the median result is 7.3. So your current target has a very meaningful chance of beating that 675. And like I said, when we showed you the table, when I showed you the table, where's the table? The table's coming up. You'll see that that's the result. Now let's attach dollars to it. Go to the next slide. So I talked to Graham at Chiron, and we got the starting point, and we got all his cash flows. Okay, so funds going in, funds going out for the next 10 years. And then we added our simulated capital market assumptions, and we get this range of potential asset value. This is actually overstating how wide the range will be. How is that? Well, you have a really good year, probably won't put as much money over time. Your funding mechanism, you have a whole extended period of really good results, there won't be as much required to go in. So the asset won't grow as quickly. If you have some bad years, your funding mechanism will require more money to get in, so the worst case won't be as bad. So,
And that gets captured when we do the asset liability
It does.
study, not in this. This is more of a, I think this was intended to be a little more just illustrative.
yeah, exactly. It's very illustrative.
Yeah.
And then this number here, the 2035 for the target 5406, a little different than what Graham showed us, because Graham is using the 675 return assumption. This is using our 7.3. Okay, but I did tie it all off. It all works. Okay, the next slide comes from Chiron, showing your funded status. You've had tremendous improvement from 84% to 96%. What we looked at as we went through this is the current portfolio's expected return at 7.3 is higher than the liability discount rate. And to the question that's just been brought up, does that mean you don't need to be reaching as hard to try to cover the 6.7? So we looked at 3 alternative portfolios that had one that had less in fixed income, so you could take more risk, but 2 that had more in fixed income, or taking some risk off the table. And that's what you see on the next page. So the policy target is the second from right. And then mix 4, we took fixed income down by 3%. You could try to pursue a little bit more return. Or what happens if you look at 2 mixes that have a little bit less risk? So mix 2 has 3% less in growth assets and 3% more in fixed income. And mix 1 has 6% more in fixed income. We didn't touch the alternatives. Okay, that's something we could discuss, but we wanted to do something simple just between stocks and bonds. Expected return goes down. Sorry.
Can you go back to 54? I'm sorry, there was a data point that this reminded me that I wanted to share. And this is back to Jay's point about the probability of beating your assumption. So I've been tracking this now. So since 1996, so 30 years, you've been higher than your assumption 60% of the time. You've had positive returns, but less than the assumption 23% of the time. And you've had negative returns 17% of the time.
I don't know what that looks like. Great. Thanks, Jeff. So what does this look like? When you go to simulate, like I said, on page 58, look across the mixes. How different are these mixes? They're pretty similar to one another. But what happens if you move leftward from the policy target to, say, let's take 6%, greater exposure in fixed income, 6% less in public equity? What does it do? Well, it lowers your probability of hitting the 675 only by about 1%. Still going to get an expected return that's above the 675. The risk comes in. So that bar, it's kind of hard to see it, but it's narrower, which means your range of potential results is narrower, which means the risk is narrower. So the expected risk, that 13.1 is the standard deviation. It goes down to 12.2. To me, that's a meaningful reduction in risk, yet you're still expected to get the return you need to meet the 675. Then if you translate that to dollars on the next page, same exercise I went through. Again, this is probably wider result than you would get if you properly measured what happens if you got really good or really bad results. But the probability that you beat, what's that 5101 come from? Well, that's if you had a portfolio that was only getting the 675 that Graham's modeling. That's the dollar amount. So that's the 5.1 billion. So each of these mixes have a similar probability that when you look at just the return of beating that. So to me, the story is, as we look through this, is you could consider a less risky portfolio. We did a simplified version by just looking at the difference between stocks and bonds. We didn't touch the alternatives. Still beat the 675 and have, less volatility looking forward. And this is an exercise many of our public funds are going through now, especially after we've gone through this 10-year run of like, wow, it's been really good. And what should we do something different?
All right, I lost my Zoom connection. I apologize. That's why it's on the screen. Hopefully
You
can
guys all have
follow
it on your
through on the
screen?
screen.
Yeah, so that was,
It's not. It dropped off the screen.
oh,
No, on their iPads.
On their, if they have their iPad in front of them, it's still there.
oh, great. All right, so that was page 59. I was
Hold
speaking.
on until we bring the
Let's see if I can
connection
get
back
it back up. I apologize.
up. Otherwise, nobody online is seeing it.
Oh, gotcha.
I didn't,
Take a break.
Jay, this,
hang
as
on.
long as we're waiting, this assumes your 10-year market assumptions are correct.
It assumes that's what you get. That's
And,
correct.
and if you went back 10 years from today, what did your projections look like and how do they compare to what happened?
I have a chart to show you that, so we get it all back up here. We track our track record. Yeah.
Which batting it?
Our batting average- Well, what we look at is what did we say in expected case, and then what was the range of results. And I'll show it to you in a moment when it comes back up, but in general, we are well within one standard deviation of a set of expectations, and quite often we're right on the button. We're back up, okay?
Sorry about that.
No problem. So to address that specific question, if you go all the way back to slide 91. The way we put this is not your portfolio, but the way we put this together is we take a portfolio that's 60% equity, 30% fixed, 10% real estate. So a little bit less conservative, a little bit more conservative than yours. We come up with a set of we have projections all the way back to 1989. One of the problems of being in business for a long time. Someone can check your track record. I've been doing this since 98. So I own everything from 98 to the right. What are our expectations? So the blue is the the orange is the projected. So in 1989, we projected that dot. In 1998, we looked back and said, that's what we got. Does that make sense? How to read this?
What slide are we on here?
91. So then we can have one standard deviation above and below, and two standard deviations. I don't think we projected
No.
two standard deviations. I don't know why we put that on there.
Because we didn't need to.
Right. Now, so where did we fall apart? Well, in 1999, we had a projection that looked like, an 8% return. And then we had two major drawdowns in the next 10 years. We had the dot-com and then we had the GFC. So we managed to get two that I think happen every 10 years within a 10-year period. For the most part, to be honest, I am surprised it's as good as it is, not as far away from the center line as it can be. We do a better job at total portfolios than we do at individual asset classes, but I think we've done pretty well at capturing what expectations are. So to answer your question, 10 years ago, the projection would have been 2016, and it would have been 8. Now, is your 10-year? Well, I'm trying to get this here. Performance. Where's the? Yeah, there it is. So so there'd be the difference between the orange and the blue.
Yeah, and the blue is a index.
Yep.
Right. It's just it's a passive 60-30, well, 10 real estate, just assuming the index return. So it's not active. It's not as diversified as actual portfolios. It doesn't include any active management or anything like that, which would obviously change the results. I would argue it probably bring it a little more close than this, but this is just a useful.
Oh, plus,
Right.
and I'm not going to make you do it. If you went back to that page I showed you where it had all the results, 10-year forecast, you would have got S&P, if you had S&P like results at 14%, but fixed income was only 2 because you took a beating in 2022 when we repriced fixed income. Does that make sense? No. So I'm surprised always to the upside as to how well we have done. And I think it speaks to the fact we try not to make big changes year to year, try to be mindful of the 10-year forecast.
But at the same time, there's some variance around it, to your point. Right?
Absolutely.
It is, a lot of these numbers they're projections. All of them are. So, there's going to be some variance.
This is not our portfolio. This is at 60% equity. Is that
Correct.
S&P 500? What do you?
Yes, 60% S&P 500.
Okay.
Yeah, again, so they're not diversified portfolios. Very simple, passive, just as an exercise. So that's kind of the asset allocation story. Again, the current policy was restructured when you eliminated public real assets. It was reallocated. It resulted in a slight uptick in public equity. And the elimination of public real assets. So that portfolio, remains fine as we see it. We do think that, again, there are more conservative portfolios that still provide a pretty attractive expected return relative to the 675. And we've been messaging this for a while, right? This is not new. As rates have kind of normalized and as your funded status has continued to improve, and we've argued the case that, you know, on the margin, you could de-risk if you were to be selling. And, you know, this isn't, these are marginal changes too. We're not suggesting any radical restructuring. These are changes, I would argue, much more on the margin.
Okay.
Any,
That's
any
presentation.
discussion on this
Yeah.
particular topic? That what we were going to pivot to next is we're going to just take a closer look at broad U.S. equity. We're going to take a look at global non-U.S. equity and then fixed income. Again, we use proxies to model those asset classes. Those are the benchmarks that you use when you benchmark your portfolio, but you have the ability to implement differently than the benchmark. You can buy the index and just do it simply that way, or you can restructure it. You can either restructure the exposures that you get, or you can use active management or some combination thereof, which is what you do. So we were going to take a little closer look at that because, again, those have been questions that have come up over the last year. But I think it's just a good pause here to see if there's any discussion that the board wants to have on the broader asset allocation.
Comments right now?
Stunned silence.
Okay, so, Mr. Chair, you can keep going. Obviously, that's fine. Lunch is here. If you wanted to take a break, grab lunch, then come back and then restart, that might be an efficient use. There are some trustees I know that have time limitations, so maybe that's not a bad idea to just take a short break and allow people to pick up their lunch and then come back and start at whatever time you think to start. Or you can keep going. I just wanted to.
I would like to take a break now.
Okay.
Food, what's an appropriate time to get back?
About 12:20.
Deal. Okay. 12:20. Sure. the investment committee meeting back to order. Okay, where were we?
Moving on to slide 61. Jim was giving a preamble to this. We want to look at the asset class implementation for public markets. The first thing we'd start with is your benchmark. So for MSERA, for the public equity, you use the Russell 3000. So it has large, mid, and small cap. So that's what's highlighted here on the left.
And it's intended to represent the investable universe of publicly traded US stock. That's why it's not, there's nothing really magic other than that about it.
Right,
That's,
right.
it's the opportunity set.
Right. And so typically, and as a comparison, the Russell 3 is made up of the Russell 1000, which is large and mid cap stock, and the Russell 2000. Many use the S&P 500, which is the 500 of the Russell, roughly the top 500 of the Russell 3000. And then S&P has a mid cap and a small cap, but they only use 1,500 stocks. It all, their returns are within decimal places of one another. Their correlations are close to 1. So it's really just a matter of preference. But the Russell 3 is a perfectly fine index. The biggest change that's happened over time is capitalization. When I started at Callan in 98, the rule of thumb was typically 20% in small cap and 80% in large. Now there's only 4% in small cap. 4. Mid cap is the bottom, essentially the bottom half, well, the bottom 800 of the Russell 1000, how they measure it. So there's a very high concentration toward large cap stocks in the Russell index. For non-US stocks, and we'll come back to that, what it means for you. Go to the next slide, we look at non-US equity benchmarks. Here it's a case of what do you wish to include and what do you not wish to include. So EFA, which is Europe, Australia, Asia, Far East, very US oriented terminology, was the original. And that was essentially developed markets overseas, but not including Canada. Then there's World, which is really what's been most people use, World ex-US. So that just throws Canada into the mix. But that does not include emerging markets. It does not include small cap. Then you get to the all country world index, ex-US, which includes developed markets and emerging markets. And then you throw on the word IMI, which is investable market index, add small cap. So you have all country world, ex-US, IMI. That means you have large, you have small, you have developed, you have emerging, and you have small cap in all of those.
So like the Russell 3000, which is the investable universe in the US, the ACWI ex-US IMI is essentially the investable universe outside.
Right.
So you have the broadest benchmarks for both US and non-US.
Right. So if you then go to look at how you are invested across your managers on page 63, in domestic equity, you have the Russell 1000 index, passively invested through SSGA. And then small cap, you have invested with DFA and their small cap core. The index that are used for each of those pieces are the Russell 1000 for the SSGA, which makes sense, it's the Russell 1000 index, and then the Russell 2000 for the small cap. So you're passive, 75% of this domestic equity, 25% is active, and that's all in small cap. And you can see the dollar amounts.
So there's been an active decision to overweight small cap.
Right.
And that active position has grown given the fact that small cap has become less and less. So one of the questions back to you to decide today or in the future is, are you still comfortable with that degree of small cap overweight, or is something smaller more reasonable? Given that, again, your benchmark for the asset class, the Russell 3, has meaningfully less in small cap. We've talked about this ad nauseum. I'm getting sick of it. I'm sure you're getting sick of hearing it. But small cap, there's been a big headwind against small cap. Right? Large cap has done meaningfully better. Not that small cap has produced bad absolute returns. Back on that chart that Jay showed of performance, I think the 10-year return for small caps compounded at 9% or something, which is pretty good again in absolute returns, just well below large cap, which was 14.5 or almost 15% over that same period of time. So, always good to kind of reconsider that decision of the small cap overweight and the magnitude that you have it, is it warranted? Why do you do it? You know, over very, very long periods of time, small cap has done better than large cap. I mean, there's a lot of debates whether that's going to continue in the future. And it's also an area where small cap active managers have demonstrated an ability to add value. It's an area where if you're going to use your active management budget, that's usually a good spot to spend money to hire an active manager because they can typically add value net of fees over the index. The FA has done that over the long haul. Again, it's been more of the strategic positioning as opposed to a manager specific issue.
So Jim, I think you just said, or Jay said a minute ago, that 4% of the 3,000 is small cap.
Yeah.
And we're at 25%.
Right.
And actually, we were probably much higher than that because small cap has had a really rough 5 or 10 year period. So I don't know how long we've been in the fund or how we got there, but it's been a meaningful drag against the benchmark performance. So what is your recommendation, I guess?
So yeah, again, it's had a rough period in relative terms. Right? 9% return is pretty good. It's probably higher than what we predicted 10 years ago. So just to keep it in that context, but it's underperformed large cap. It's been a headwind. I think you know, our opinion is that we're still comfortable with some small cap overweight relative to the market, but probably not to that extent. If left to our own devices, if building a portfolio today, we would probably have something that looked more like 85, 50.
And the 10
As a starting point of discussion.
and the 10-year forecast you gave us for expected returns, that has 0% small cap.
No, it has,
You
it
said
has
small cap.
it has small cap. The Russell
thought-
3000 has.
No,
large
I'm
and
talking
small.
about the performance you showed us for the 10-year outlook was 60%. You said it was yes.
Oh, over history when we're doing the.
That was a historical look.
Yeah.
Looking forward, if you go back to the assumptions, we're actually expecting a premium for small cap over the next, what was 20 basis points premium. And again, that doesn't include anything that you might capture as an active manager on top of it. So that's why I would say overweighting it still makes sense, but to a lesser extent than what you have. This creates a lot of disparity between the performance of your portfolio and your benchmark, more than, you know, I think is probably reasonable. So that's, again, that would be our starting point for discussion if left to our own devices, would be to keep it, but reduce the overweight.
And how does DFA over the last 5 years compared to its benchmark?
Again, we'll show you the actual
Okay.
performance in a minute, but they've done a good job of executing. They've added value net of fee over the long periods of time. So we're still confident in what they do and how they do it. So it's not a DFA issue. It's really a structure issue.
One of the challenges for many who have big small cap overweights, and we do have other clients, is their small cap manager beats the index by 200 basis points, but large cap beat small cap by 400
Yeah.
basis points. Does that make sense?
That makes sense, yeah.
Yeah.
Now, that said, I mean, again,
Yeah.
we don't have crystal ball. We don't know, but we've also spent a lot of time talking about the valuation of the market, how much the valuation of the market's driven by large cap, and particularly you have a lot of concentration in your Russell 1000 position, right? So 25% of your total, almost 26% of your total assets are in the Russell 1000 at the plan level. 40% of that is in 10 stocks. Right? So you're talking at 6.5% of your total fund assets are in 10 stocks. That's really concentrated, way more concentrated than it's ever been. So that's just another layer to this argument of,
If you took those 10 stocks out, how does the large cap versus small cap play out?
in terms of the weighting.
No, in terms of performance.
Oh, I mean, it would close the gap meaningfully. Yeah, I don't have that attribution in front of me, but yes, that 15 versus 9 over the last 10 years, it it would be much smaller. So yes, they've done extraordinarily well, and you can still find a lot of enthusiasm for them and their growth potential going forward. And they said they're making a lot of money. Their valuations are high, but not like absurdly tech bubble high. So again, you get reasonable arguments on both sides of it, but it's been a long, successful run. And, again, it's back to Jay's periodic table, right? Buy high, sell low, diversify. That's the takeaway.
In that spirit, let's call it the S&P 490. The S&P 490, you can make an argument that their valuations have been artificially bumped up as a result of these 10 companies. So if and when there's a pullback in the market, I don't know what the beta is of those 490s, but can you make the argument that they will overshoot on the downside as well?
I would say
Simply because those 10 companies are a real profit maker. I agree.
they are, but they're the ones actually that are taking the big hits. So, I mean, since January, those Mega 7,
Yeah.
Magnificent 7, Magnificent 7, confusing terms. They've taken a beating. Several of them taken a real beating.
And mixed, it hasn't been
Several, right, exactly. Like by beating, I mean 15% down.
Sure.
So my argument would be, they'll be the ones to make the bigger moves, and the total market may tilt down and up with them.
Well, and I mean, I think there's another element to this, which is flows. If
Right.
you start getting flows out of the market,
From the institutions.
and half the market is indexed,
That's a structural risk.
just by definition, the money's going to come out of those stocks. Right? And because they're waiting so much, it's going to have an effect on the performance. So flows are a big part of it. It's hard to predict flows. I will say this though, in that, certainly if the markets turn negative, you get outflows. There's also this counter mechanism in our world today that I don't think everyone appreciates, in that every 2 weeks, there's an enormous amount of money when payroll comes due that gets contributed to 401k plans, that goes into target date funds that are enormously weighted towards stocks and large cap stocks and index large cap stocks. So that's a counterbalance to the cash flow that comes out of the market. And I haven't really seen any good numbers as to what that is and how that impacts, but that's sort of like this natural buttress. And 401k participants are traditionally, there's a lot of inertia in that they don't typically and en masse make a lot of changes, particularly those that are in target date funds. It's supposed to be kind of like set it, forget it, don't think about it. So just another factor there, but flows would have a big influence on that story.
Right. The other flow that has some concern is, as these, defined benefit plans like yours get very mature, they will become net negative cash flow. You're gonna have to sell stocks. There's nothing wrong with it. It's the nature of it, right? And as there are fewer of them, I mean, we're working with a lot of closed corporate plans. By closed, I mean they don't let anybody else in it, and even some of the people that don't earn any more benefits. So they're going to start selling massively over the next 20 years. Some already have, right? I mean, you already have corporate plans that only have 20% stock, but they're a lot smaller than your plan.
All right, so that's one issue to noodle on here from structure. We'll keep this moving forward.
Right. Okay, so for non-US stock, you have 50% of non-US equity is in a world ex-US fund. So again, that's all the developed markets, including Canada, but not the US. Large cap. Times Square is an international small cap that is focused on developed markets. KBI, we moved from the real asset portfolio, and it is benchmarked as a global portfolio. So it's in the non-US. There are some US stocks in it. It's a global mid cap, so small and mid. And then FIAM has your emerging markets exposure. So you're half active, half passive when it comes to international equity. So passive on the developed market, large cap, active on small cap, the Global Natural Resource Fund, and emerging markets.
And in terms of, again, when you look at where where are you getting your biggest bang for the buck to use active management and equities? You have it where we would agree that that's where you see it. Small cap around the world, emerging markets, large cap in the developed markets, US and non-US, reasonable place to be passive. And that's kind of where you've ended up. So.
Right. And then for fixed income, you're using the aggregate, but you have two active core plus managers. And what that means is the aggregates, they're benchmarked. Core plus means they're allowed to go below investment grade. They're allowed to go outside the country. And so they'll have different weight, and they'll typically have different weightings, less in treasuries, more in credit. I'll show you that.
The only thing I would add to that is that the plus part, they have the plus, meaning they can go outside of the benchmark, high yield, non-dollar bonds, emerging market debt, typically being the main components to it. But it's capped. Typically in aggregate, it's on average 20 to 30% maximum exposure to those plus sectors. And in most cases, active managers don't use that full budget of plus. It's rare that you ever see any of them in the universe get up against that range. And Wellington and Dodge and Cox have, haven't come close to the full extent of what you've permitted them to do in the guide. But they do have those arrows in the quiver when they see value.
Right. So to summarize all the exposures on page 64, I would look on the left, the US, non-US split, MSERA at the top, the ACWI, IMI on the bottom, you look like the market, which is what we think makes a lot of sense. Unless you have a strong desire to tilt, look like the market. Let's start at the bottom, international large versus small. Again, you look like the market. Developed versus emerging, you look a lot like the market. It's large cap versus small cap in the US where you look very different. That would be this ongoing discussion of large versus small. Okay.
Pause.
You want to take a pause? You want to ask more questions on that? Okay. For fixed income, again, you have two core plus managers. What does the index look like? It's, Jim doesn't like it. I don't think many people do, but it essentially covers treasuries, corporate bonds, and then all the agency bonds. So agency / RMBS. So there's mortgages in there. There's CMBS is a little tiny bit of the mortgages. There's government related. It does not include non-agency mortgage-backed securities. It does not include high yield. It does not include non-US. It does include dollar-denominated non-US bonds, and it doesn't include emerging markets. It's kind of the broad starting point.
Well, let me explain why I don't think it's a good index quickly. So it's weighted. The weights that you see here are based on issuance. So it's not, the size of a company, that Microsoft's a big company because it's been successful and it does a lot of things. That's reasonable. That's a reasonable story. No one builds a bond portfolio that says, I'm going to load up on who the biggest debtor is. It's not a reasonable way to construct a portfolio. Right. So that's why I don't think it's a very well constructed index, because it's based on outstanding debt issuance, which is not how anyone would think about building a portfolio, diversified portfolio bond.
Right. So we favor active management typically in fixed income. And one of the first moves many make is away from treasuries and toward credit. And then Core Plus allows you to add even more than that. Why do you have bonds on the next page? I think this is an excellent chart. It's just looking at the role of fixed income when you have down markets. So these are all the down markets I found across the bottom. And you have stocks and bonds. Down market being a stock market down market. So you'd expect them to move opposite to each other. The only time you see it together is look at the third from right. That was 2022, when you had two storms going on, raising interest rates a lot that caused both stocks and bonds to take a hit. And you can see that the high yield corporate index, which is light blue, looks a little bit more like stocks than it does like bonds. It's credit exposure. So that's why you would have any bonds in the portfolio, these dark blue lines that are moving the opposite direction when you have a market drawdown. In terms of employment, you've gone with Core Plus. You've got Core, the pros and cons of both. We like Core Plus. The idea is that the managers typically add value. They will make bets on sectors. They will make bets on going outside of the index. So you get a moderate total return. The reason why there's cons is you're going to get a higher tracking error, and that some of the non-index securities they may go after, or the tilt towards credit, will add more equity-like risk to the fixed income portfolio. And that-
On the margin.
on the margin,
Because it's a small, typically a
right. So how you can see that will play out is on the next two slides. I'm just showing you the exposures to debt to ratings on page 68. So you typically go through a little bit lower rated bonds, which have a typically higher yield. Okay, so more in double A, or excuse me, less in double A and triple A, and more in A, more in B, more in high yield. And then if you look at sectors, again, massive underweights to treasuries with a lot more exposure to credit, in search of a higher yield. And then as you look at, go to page 70, trying to sort of sum up the role of active management. Jim's already made these points. Take your bets where you think you can get the better bang for the buck. So large cap, very efficient, small cap, much less so. Non-US, large cap, more efficient, small cap, emerging markets, much less so. And in fixed income, we believe in the active management premium.
Lately, there has been two major bond floated offerings by two corporate plans, super long dated bonds. I think it was, I believe it was Amazon or Alphabet, maybe both. When I say super long, I think they're 80 or 100-year bonds. But, and in certain parts of the world, that's kind of normal, like you go to the UK. But what's interesting here is that they're offering these bonds in the currency, in a currency other than the US dollar, like the British pound and the Swiss franc. Are these just canaries in the coal mine, or have you seen this before?
I've seen them in the UK.
Right.
I haven't really seen them here. I mean, they're not large denominations.
Not, the UK issued bonds haven't been in a different currency.
No, you're right.
They've been in the pound.
Right.
Yeah, they've been in their home currency,
Right.
but here we
Right.
have two major American corporations that are now floating bonds elsewhere using that currency. So I've never seen something like that before either, but I'm just curious, is this something foretelling about our fixed income markets here? And should we be thinking about that a bit more?
I don't know the answer. I suspect that some of that may be issuing in the currencies where local investors are hedging liabilities in those currencies, and so there's a better match. Because there's a lot of, especially on the corporate side, there's a lot of LDI matching in both in Switzerland and in the UK.
Right.
So and again, those liabilities are super long term, so it might help them as they're thinking about matching their liabilities across a yield curve to get some exposure in their local currency way out, may have some appeal. So I don't know if I think it's probably driven more by that as opposed to any bigger
Any commentary about our
broad,
home?
like issue. Right.
Yeah, you have to believe that both of them heard there would be demand for such a thing.
For sure.
Here's another interesting thing that is developed, that's coming out of the market. Let me go back here. So this corporate component, which is about a quarter of the ag, if you looked at currently the 10 largest issuers of that index, 7 of them are financial institutions like JP Morgan, Goldman, Citigroup, Morgan Stanley, very financial concentrated. The expectation is in very short order, that index is going to be very tech heavy because there's so much spending on AI that a lot of the big Mag 7 and other big tech companies are going to the public markets to issue, finding it favorable there, and their investment grade. And that index is going to become the index itself is going to become much more concentrated in tech. So it's going to look more like the equity index, which is another reason why it's a bad index, because then it may provide less diversification to equities, which is one of the big reasons you invest in bonds, is to get diversification to equities, which is the power of this chart, right?
Those were the comments we had on the public parts of the portfolio. Oh, I don't know, Jim, where you want to take it? from
Yeah.
there?
So again, I think the big thing there is, again, just to recap all of this is, asset allocation wise, there's some things to think about. There's nothing urgent there. On the structure side of it, the thing that sticks out is the dramatic overweight to small. And, is the board remain comfortable with that overweight to that extent? Or does the board want to act on, or anything else that we talked about? I don't mean to say that's the only thing, but that's from our perspective, that's the thing that jumps out.
Anyone have any thoughts, comments today?
Question, Jim, you were talking about how you don't like the index, but our two fixed income managers are really kind of stuck on that index with a little plus, and you said they usually don't even use the range. I'm just curious why we're not looking at other managers that have a little more flexibility. Many of them do incredibly well with hardly any more volatility.
So when you say they're stuck on the index, look, this is the average core plus manager.
Yeah, I'm just showing the average.
But look how different that they actually are. So they're basically saying the same thing I'm saying, which is like, I can do way better than the index. Where they're constrained is more on the duration side of it, which is the interest rate sensitivity of the portfolio. So the index itself, the ag, has a duration of about 6 years, roughly. It ebbs and flows. Let's say it's 6 years right now. What that means, a duration of 6 years, means that if you were to get a 1% move in interest rates, you'd get a 6 percentage point change in the price of the bond in that index, assuming the yield curve moved in a parallel fashion. So a 1% increase in bond yields means a 6% decline in the price of the bonds. And vice versa, if yields were to go down 1%, you'd get a 6% increase. So that's what the duration means. And the managers are in this universe, and your managers are constrained in how much risk they can take away from the duration of the index. Typically, I think we give them 20 to 25%. So they can go long a year and a quarter, or short a year and a quarter. So it's going to be 4 to 6 years, 3.5 to 6.5 years of duration. And what's important about that is that this right here is driven by the reason those green bars are positive, and the reason that fixed income has provided to be a pretty good diversifier is because of duration. It's interest rates. It's not credit. Again, if you took a lot of credit risk, you can go down a lot if you're in high yield. So you want to make sure you have interest rates in this portfolio. If you were to let a manager become unconstrained and they were like, yeah, you know what? I don't want to have any duration in my portfolio right now, and the stock market were to sell off, that portfolio is not going to hedge that drawdown in equity because they don't have any interest rate sensitivity. So you need rates. We would argue rates are an important diversifier to fixed income. If you want yield and you want credit, you can go elsewhere. And we're going to talk about that in a minute. Right? There's other places you can do that. We would argue in this portfolio, 23%, back to my comment, you have a pretty risky portfolio. I think you want this portfolio to behave. You don't want this to be sexy. This is boring, income, liquidity, diversifier, downward protection. That's what you want from this portfolio. You don't want to lean into risk. You can lean into risk in other parts of your portfolio, and you do. That would be my counter to that, Bruce. You're right. There are managers that do stuff. I think some of that lack of volatility that you've seen in some of those strategies is the fact that interest rates have been so low. So there hasn't been that the volatility of those strategies hasn't necessarily come through of what you might expect going forward, given the normalization of rates.
Yeah, I'm not saying we want to take a bunch of risk, but I feel like your number on the ag is like close to zero or something.
Yeah, again, it's, all- I mean, the current level of yields in of the index is a pretty good future indicator of performance. And so that 475 that we showed, that's over the next 6 years, which is the duration of the index. It's kind of what you should expect from bonds. And if you go back and you do that chart where you say, what's the yield today? And then go forward 5 years and look back at return, it almost plots on top of the line.
So just, and I don't want to take the whole meeting, but so what I'm hearing you say, Jim, is you don't think there are other managers that could take on a little more flexibility and provide significantly higher return without significantly higher.
I think it's the last point of your sentence right there is the trade-off is that I think you're taking on more risk. If you want that extra return, you're taking on risk, either that you're relying on someone to make interest rate bets so that they're making a bigger duration bet, or they're investing in more credit-oriented strategy.
Yeah, okay.
So if you look at those unconstrained strategies that are out there, PIMCO, Income, Dan Iveson's fund, things like that, they have a lot more guideline flexibility than what you allow these managers to do. They've executed very well, but I would argue there's a lot more risk in that model that could come out.
One of the challenges for high yield right now is that spreads are really tough.
Yep.
And so when spreads adjust and blow out, that means you take a loss.
Unless the manager can, have the foresight to rotate out of them, which is again, a reason for active management. So,
Yeah,
Yeah.
And the PIMCO fund you mentioned is triple the ag over 10 years, which is meaningful.
Yeah, and the only-
they're not just jumping into high yield. It's a pretty conservative strategy in the scope of fixed income.
they have had a lot more credit risk in there, and he made a great duration call in 2022, right?
Well, for 10 years,
He made a great duration. So when bonds were down 13% in 2022, he was like flat because he had no duration. So he made a great call on that. So, yeah, again, that's just a trade-off of risks, right? You're just it's a more active approach. There's risk involved in that. And you can weigh that, right? You could definitely weigh that in the portfolio. I would argue if you had higher bond allocation, if your bond allocation was 30%, you'd probably have more of an appetite to incorporate that kind of stuff in your portfolio. We would argue the lower and lower your fixed income gets, again, the more fixed income characteristics you want to get at. Because it's there for a reason, right? It plays a role. You want it to play that role.
Feeling a strong sense of making motions for big changes today. So let's, are we at the point where we can start talking about the private credit?
We are.
Great.
I will ask Oz to come up to the table.
I got you.
I can take those.
Oh,
Gotcha.
you're the man. Thank you.
Hey, full service consultant.
Earning those points, right?
Yeah, you're the man. All right, while Kaz is in transition here, let me just give you a quick overview, recap of where we've been. Kaz was here in May last year. We did some educational overview of private credit, talked about it, and an allocation, the board approved an allocation, dedicated allocation to private credit of 5%. In December, Kaz was back, and we talked about how you might structure that 5% allocation. So we presented some pacing analysis. How do you get to the 5%, over how long? What types of strategies within private credit might you look at, vehicle types? And the decision was to commit $100 million in 2026 to evergreen strategies, which Kaz will get into in a little more detail, and to split that 60% to direct lending strategies and 40% to asset-backed finance strategies. And so Kaz has been busy at work with the private credit team, with those marching orders to come back today to present some candidates for consideration. I don't think you have to make any decisions today other than the next step really in this process, which is the last part here, which we've labeled summer of 2026, would be to bring all of these managers in at some point in time. Maybe might have to take a couple days to do it, given the number, but would be to bring them in and interview them with the idea of making a selection of some group of those managers later this year. So again, Kaz and the team have done a lot of work on this to bring candidates we think are top tier to implement this strategy for you going forward. And he's here today to answer any questions you have and maybe just spend a little bit of a color on the search process, how we've thought about it, some of the things we've keyed in on in terms of identifying managers and structures for you, and then we can talk about any of the candidates in as little or as much detail as you.
All right. Thank you appreciate that, Jim. Good afternoon. Pleasure to be here again with you all. So Jim went over the timeline, and as stated, the goal is to really just get us all in a place where we can start interviewing managers, dive a little deeper, and potentially make a decision sometime in the summer. As I'm going through some of the manager names today, we can certainly maybe remove some if that's a very clear X. So maybe it's not a very large number. That might take a while in a couple months, but thought it would be helpful just to start with a quick recap of the discussion on the commitment pacing and structure. Then we'll get into how myself and our private credit team thought about the search. And then we'll get into more of the specifics for the managers. So we'll start just, again, a reminder. Last time I was here showed a couple examples looking at both drawdown versus evergreen, but by implementing the private credit program through evergreen structures, we'll be able to reach the target allocation of 5% much quicker. And that'll also offer some flexibility just depending on where markets move and how we want to go ahead and implement these managers going forward. It's a great time to, of course, remind everyone that private credit is a very illiquid asset class, and we've seen certainly no shortage of headlines for some of these evergreen funds or more, I guess, retail-oriented, whether that's BDCs, interval funds, and just given that a lot of these funds have had to gate redemptions for any of the investors that did not understand the underlying illiquidity of the assets and of some of these structures. I think they certainly do now. So while this is evergreen, certainly just want to make it clear again that that is not synonymous with liquidity. But looking at this page, the expectation is to get up to target pretty quickly if $100 million is committed this year. And so that would be, a start to the program that would not be just centered as a 2026 vintage. There would be exposure to other vintage years as far as when loans were issued, which we'll get into some of the thought processes that our team has on that. We can go to the next slide from here. And then here is an example, just given some of the 2020 vintages that are currently in the private credit portfolio, which are returning capital and rolling off, more so in the opportunistic or multi-strategy space. That's why you'll see, assuming if 3 are implemented this year and 3 next year, then that number of managers will go up to 9. But then once some of those funds fully return capital and wind down, again, from the 2020 vintages, then we're looking more so at a level around 6 managers But again, that could be, changed over the subsequent years as we get a better sense of implementation. And the chart on the bottom just shows how there will be a little bit of a J curve ramp up, which is just contributions outpacing distributions early on. But the goal is for distributions to outpace contributions here in just a couple years, and have that positive net cash flow within private credit, and then really be able to have the private credit pacing and asset class be much more self-funding going forward. And this is just a reminder of where we landed as far as implementation goes. So we do think of core corporate direct lending and core non-corporate, which we'll call asset-backed lending or specialty finance, as core parts of a private credit portfolio. The more opportunistic multi-strategy funds that are currently in the portfolio, that's something we can revisit later down the line. And of course, those are winding down right now. But for reaching that 5% target, sort of taking a step back, starting ground up, just a quick recap about targeting 60% in core corporate direct lending and 40% in what we'll call core non-corporate or asset-backed finance. So here we'll go ahead and dive into just a few example considerations. This is certainly not the exhaustive list, but some that I wanted to highlight to you all today. And I can honestly say that myself and our team really found this process to be honestly like fun and very rewarding, in the sense that we were able to, since these are evergreen funds, we were able to look exactly at the portfolio construction, at the loan tape, and really be able to take our preconceived notions and our thoughts about private credit as a whole and look at implementation from right now's viewpoint. And I think that'll make sense as going through some of these considerations. But something we want to be very careful of is limited deal overlap in these managers. And that is especially important when you get into the core mid and then also upper middle market within direct lending. There's the potential where lenders enter what's called club deals, or go through this auction process where these underlying borrowers are just so large that not one lender can speak for the whole senior tranche of the capital stack. And while on the surface it may seem that a lot of that there's this vast diversification, it's really important to look under the hood and just make sure that these various managers aren't all in the same companies. So that's something certainly important to look at. Next one is vintage year diversification. I know you've heard it often, but we certainly preach vintage year diversification as well. And so, looking at, you might think, well, 100 million commitment this year, that seems, pretty concentrated in a vintage year. But that's why we also want to make sure that these portfolios and strategies that we'll be talking about are, both coming in with seasoned loans that had been made previously, or that the pacing of invested capital is going to be very structured and thoughtful. And we really want to stay away and eliminate some of the managers that might just put all the capital to work at one point in what could potentially not be the most attractive environment. We really want to focus on selectivity from the managers. Third point here is to avoid blind pool risk. So again, this is very helpful for us and for you all to go into strategies that you can actually see the dollars that have been invested, what terms they're getting, what sectors, which sponsors they're working with. You can always use previous funds within a series as a really good proxy for how they will act going forward. But being able to see exactly what you're buying into, looking at the credit quality, looking at the covenants, and then some of the other things that I already mentioned, we think is just a huge value add in making sure that we're selecting the best managers that we possibly can. Fees is, of course, an obvious one, but nonetheless very important. There's been no surprise that there has been massive fee compression, especially within direct lending over the last few years, and just us as a consultant and having a large number of other clients that are in private credit, there's the potential to benefit from an aggregate fee discount. But I want to be very clear that that is not part of the investment decision process that goes on our team, but it is just worth noting if the decision goes down and that ends up fitting the bill. Sector concentration. So we've seen a lot of headlines just about how software is a very big part of private credit, and that is a function of private credit lending to these private equity sponsors, and they have been chasing software deals for some time. So there's certainly, I think, some warranted concern around software exposure. And I'd say software and healthcare are two of the largest sector exposures right now. And so depending on how we want to think about just enhancing diversification and ensuring that the managers that we're looking at are not incredibly overweight software, just given some of the potential headwinds. I think that's very important as well. And then a lot of the, I guess more, again, just going back to negative headlines. And when I say negative headlines, I don't say that in a way of dismissing noise. We think about a lot of these risks, and they're very real as well. So in focusing on direct lending, the managers we're bringing forward are more focused on the core middle market and lower middle market. And for us, that is because in those areas, we find that there's a little less competition, more so in the lower than middle market, but the ability to get better spreads, better terms, which include covenants, and you are not as susceptible to what's called EBITDA adjustments, which takes place a lot more in the upper middle market, which affects leverage, which affects covenants, and we'll get into some of that as well. I don't want to ignore the fact that historically, and we've seen larger businesses are more resilient in a period or in an economic downturn or periods of shock and uncertainty. But just looking at the fundamentals and opportunity set, especially when we're trying to be not just close our eyes and go with a beta play in private equity, that's sort of the thought process of looking at the core middle market and lower middle market for direct lending. And then lastly, we are always thinking about what is the worst case scenario, what could go wrong in direct lending, what could go wrong in these companies. So partnering with the manager that has experience in dealing with stressed companies that have been through a restructuring or that have had a default, have seen losses, we view that as absolutely important to have a team that is ready to come in, be really hands-on, preferably be a lead lender so they can sit at the table and really dictate terms and outcomes on a go-forward basis is paramount. So with that, we'll go into, again, just how we think about manager implementation. So first of all, talking broadly private credit, but specific to direct lending, seniority is very important. We want to avoid strategies that start to go down the capital stack and implement a lot of junior notes or potential equity positions as well. So we're very cognizant of trying to stay away also from PIK interest, which is non-cash pay interest. Some people say there's good and bad PIK. I don't really like any of it. And at the onset of deals, you'll see that PIK toggles are implemented in some ways just to win deals, which is just a characteristic of the current market. But you really want to stay away from companies that are spiraling downhill and managers kicking the can down the road and implementing PIK later on. I've seen a number of issues where recovery rates just do not end up above 1 there. So anyway, focus on senior secured loans, top of the capital stack, very important. We also do not want to depend on leverage to generate returns. You have to take some risk in order to generate returns, but for us, it is not prudent just to try to lever up both either at the fund level or at the asset level. And that is another consideration for focusing a bit more so on the core middle market and lower middle market, both on the points of PIK percentage and leverage or loan to value, LTV levels as well. We want to focus on some kind of premium, some kind of structural alpha from these managers as well. Again, this sort of goes back to the point of not just setting it and forgetting it in this beta play. I would say I used to fight that some areas in private credit, especially direct lending, were turning into beta, but can't be stubborn. There are a lot of areas that have minimal dispersion and act very similarly, a lot of times by being in similar deals. So we want to go with managers that truly have a structural edge and have unique sourcing capabilities and are differentiated. I know those are probably words that you hear a lot from managers as far as differentiated, unique and whatnot, but that is the goal for us to find. And then lastly, for style emphasis, just making sure that we're looking at managers that are not going to be crushed by investing in cyclical sectors and just this is supposed to be a long-term, all-weather approach. Yeah, I already touched on a few of the avoidance areas as I was going through the style emphasis, but just to tick down some of these, there's been no shortage of new entrants into the space, and so having a strategy with a long track record with the team that has been in place for a while is very important, and especially just because there are so many options. We don't really see a huge reason to take a big risk on somebody that hasn't proven themselves. Similarly, if there's no edge in sourcing and we see managers that are constantly just in an auction process and might tout that they've won X number of deals, a lot of the times that's because a lot of other lenders passed on it or because they were the cheapest bid. And neither are good cases there. So yeah, we could go to next page here. Looking at manager selection. So our private credit team, we are very busy as far as taking manager meetings, trying to leave no stone unturned. So thankfully, when it comes to both direct lending and ABF, this is not something where our team starts from scratch and we say, okay, we have this assignment, let's start this, RFP process. We already have a very good idea, just because we speak to so many lenders and managers, but we have constant meetings within the team, constantly taking manager meetings and constantly challenging both ourselves and amongst our team on bringing the best ideas to the table. But of course, at the same time, everything that we do on a client basis is very customized and bespoke conversations. So like this example, looking for Evergreen, that's something that our team talks about, has a series of meetings, and then we'll go put together what we'll call fact sheets, which is quick 4 to 5 page documents where we'll go over basic terms, firm overview, strategy, look at performance, and then put together what we call merits and considerations, which are more subjective talking points that our team discusses. From there, we'll go through what we'll call quantitative analysis, where we do not just take what the returns that the manager is giving us at face value, or sometimes the loss or default rates that they give us as well. So we'll actually go through a full loan tape, and we will compare that to a public benchmark, like a public market equivalent, utilize the cash flows on a time value basis, and do attribution as well, where we can really drill into how they've performed in various sectors, which sponsors that they work with have performed the best, and in other cases like geography or other metrics like that. And then we'll go through, put together a full due diligence report, and then we will bring, once we get to a point where there's actionable dollars ready to be committed, that will go through our alternatives review committee, and that'll be a full final due diligence report. So that is the process and structure there. I'll take a quick pause just because I wanted to spend that first part to get you all comfortable with the process and things that we look at. And so next we'll get into some actual manager names. Are there any questions so far?
Well, the semifinalists.
Move on to semifinalists? Yeah. Perfect. Yeah, so here we're putting together, there's 7 names total, as you could see, split between direct lending and ABF, or asset-backed finance. Within direct lending, split between middle market direct lending and lower middle market direct lending. On this page, this is more broadly overview, just giving you a sense of some of the more high-level terms of these strategies. You could see for middle market direct lending, target net IRRs generally in that 10 to 13% range. Golub just slightly lower there. I think one of the key areas to focus on here is, well, there's a couple, but certainly leverage. You could see that the range is generally 1 to 2 times. We would prefer to keep that a little bit lower if possible. And a lot of these offerings, I'll throw it out there, do have unlevered offerings as well. So I want to, throw that out there for you all to keep that in mind. But we believe roughly a turn or maybe 1.5 turns of leverage is prudent in this environment in order to reach these low double-digit target returns. And we've also sorted these managers in terms of borrower size, so target company EBITDA. We'll start here with Neuberger Berman. Neuberger Berman has had a very long track record in direct lending. Neuberger Berman Eagle is their evergreen vehicle. Their stated EBITDA range is 25 to 100 million, but from what we've seen recently over the last year is that's generally been about 50 million plus in EBITDA, sometimes reaching a little bit over 100. So while we still do think of them as the core middle market, they have shifted upwards a little bit. And what I will say is that is not unique just to Neuberger Berman. That can be said across a lot of middle market managers as well. But we can talk about the more specific terms just as far as lockup. And lockup is essentially the investment period where upon commitment, you cannot get your money out even partially as far as submitting a redemption request goes. And then post that lockup period, then these are the windows where partial redemptions are available. And in these cases, these redemptions are generally made in what we'll call a slow pay mechanism. So I want to be clear that these managers they do not have a cash sleeve or a bunch of public fixed income that is used to generate liquidity. They also do not plan to sell these assets on the secondary market for a discount in order to fund redemptions. So the income is going to come organically from the underlying investments. And upon redemption, you'll essentially be entered into what's called a liquidating or slow pay sleeve that will return capital over time. We could get into some more of the nuances to that, but just wanted to make that assumption clear up front. So yeah, Neuberger Berman, I think one of their big value adds is the fact that they are also LPs in a number of private equity funds. And the way that I think of that is some lenders feel pressured to lend to private equity sponsors in order to continue receiving deal flow and continue receiving looks. But the fact that Neuberger Berman is an LP and does invest in a lot of these GPs, it isn't exactly that same relationship because they are always doing business together. You could think of it as a little conflict of interest there, but those are two very, very separate businesses. And so
the second layer of fees.
yeah, and sorry, I don't mean to confuse Neuberger Berman's direct lending practice with them having LP interests on the equity side in these GPs. Right. Yeah. So
You did confuse, sorry.
yeah, no, and I was hesitant to even bring that up because that confusion is plausible, but no, completely separate. It's more so from a broader firm ecosystem and just the fact that they have really good sponsor partnerships is all. But yeah, moving on, looking at Golub. So Golub has their core competency has always been middle market direct lending. A lot of these other firms do a little bit of everything. So it's quite admirable that I think, looking at the firm that Lawrence and David Golub built, they've really just stayed true to core middle market direct lending, sponsor backed, and have not fallen into the temptation of creating numerous other business segments and really just stayed true to what they know. They are a very well-known, very respected lender in this space and have a very long history with some fantastic sponsor relationships as well. So their target, again, they'll say 10 to 100 million EBITDA. I think we'll see median come in a little bit on that higher end, but their main focus and ideas working with these private equity sponsors sort of across that pretty wide spectrum in the sense that they like having repeat borrowers, right? They're okay with going with a smaller business that they see in scale and continuing to work with them and just supporting their needs, which we've seen them be successful in doing since inception. Moving on to Audax. Audax does have a little bit higher leverage than the others in this space, but this fund goes all the way back to 2007. So the longest track record that we've seen as far as an evergreen offering goes. Targeting 10 to 12 net IRR. Again, a little bit higher on the leverage side, but really long history for that fund and also, just looking at that team that has been in place for a while. And again, just going back to the sponsor relationships that they have and just they've been doing it for such a long time that we find that as a compelling offering as well. you may hear maybe a little bit of repetition in some of my comments, but I also want to be clear that there are a large number of firms that did not make this semifinalist list where we did not feel like they had true differentiation or valuable sponsor relationships. So this is all the names on here is really the goal is to show you the best of the best and yeah, just present you with options in a case where we are happy with all of them that we're presenting and just want to get you all to a place where then you are happy with the selection as well. So just taking a brief pause and step back there. Looking at the lower middle market, so TPG Twinbrook or TPG Angelo Gordon Twinbrook. This is, in our view, certainly one of the best lower middle market managers in the space. And I think that has also been shown in their fundraising ability, just looking at other investors, other LPs, and just, the size of their funds. There is a risk that maybe since so many LPs want to work with them, that the fund size can grow to an amount where the opportunity set may not be conducive for the invested capital or the committed capital that they need to put to work. But in talking with them and looking at just the fund caps that they have, we believe that they will be able to still implement the strategy that they have over the years and still be successful in it. Target company EBITDA, much more so on the smaller end. So quite a wide range here of like 3 to 50 million. But for both Twinbrook and Fidelity, we can expect a median EBITDA at entry point of around 25 million. And I think while maybe not explicitly stated in the target net IRRs, comparing lower middle market to middle market, we do expect a little bit of a return premium in lower middle market direct lending based on a myriad of factors, but one, less competition, two, just better spreads, partly due to less competition, but also because there is inherently some increased risk with smaller companies that might include a more concentrated borrowing base, or some of these companies that are just trying to scale and grow and maybe don't have as much cash on the balance sheet. But anyway, these lower middle market companies expecting a little bit more return compared to middle market. Fidelity is definitely a newer entrant in the space, but when we were looking at lower middle market evergreen offerings, we were actually quite pleased with our initial meetings with Fidelity. And I haven't talked about the very far right-hand column yet, but that is the status of Callan's private credit team's underwriting on these managers. You can see 5 out of the 7 we have completed due diligence on and have full write-ups and client interest. Audax is advanced and Fidelity is initial. So these are areas where, just given the timeline, which, we hope works with you all in deciding on managers to move forward, that'll get to a completed space in the next few months. Maybe I'll take a brief pause there on direct lending before speaking about ABF.
Hi, I had a
Yes.
question. So this lockup period, is that something important to consider, or is that just kind of, I don't know, does it make a difference?
Yes, so good question. I would say I don't believe that it makes a huge difference if we all agree that this is a long-term strategic asset class for the plan, and to yeah, and basically just to commit to not, I guess, changing our mind as far as trying to, whether let's time the markets or, be strategic by going in and out. I think by utilizing these evergreen vehicles, it does give you the flexibility in the sense of you could be a little bit more precise with pacing and potentially rotating around some verticals within private credit. But yeah, really just looking at the lockup, it's just ensuring that you're not in, I guess, the same pool or in the same bed as like retail investors, which what we've seen in these BDCs or Cliffwater, where redemptions are above a certain threshold. And in those funds, they are required to pay out a certain percentage of NAV, which is usually 5%. And then that can create a lot of issues from an asset liability mismatch standpoint. So that's sort of a long-winded way of saying that lockup is just a reminder that, like, full stop, unable to put in a redemption request and start getting money back. But at the end of the day, these are the same assets that are going to be included in drawdown vehicles, which follow a true fund term of usually 7+ years, and have a defined investment period. And then
One way I've always looked at it too, just as an added perspective, is that, when you're going in, you're like, oh, we're locking it up, that's thing like that. But once you're in, you like the lockup, right? Because then it deters bad behavior from other investors of trying to leave and get their money back out, right? It's like they're going to manage it in a responsible manner, which is important for you as an investor. That's what you're. So, yes, you have to commit for a while, but, Kaz made the comment earlier, just because these are evergreen doesn't mean they're liquid.
Administrator Wickman.
I just want to go back to your question, because I think the shorter answer to me is yes, it's important for you to consider. How important? They gave you the back half of the answer as opposed to the front half of the answer. It is a factor for you to consider. How important it is in the consideration, they just explained that, and you'll weigh that.
And if you're in a drawdown vehicle, right, you're committing to a fund that has 7+ 10-year life, which you could potentially sell in the secondary market for discounts or whatever. But yeah, so there's again, there's not liquidity.
Things look like they're going really badly. You're going to wish you didn't have it, but then everyone will be rushing to the exits. It wouldn't matter.
Question? Cause looking at these returns, 10 to 13% IRRs, and then looking back at the return projections that Callan has for private credit, 7.25% at your 10-year production. How do those two compare?
That's something that I was talking with Jay about earlier, and I may have you start answering this one.
Yeah, I mean, I think by and large, if you looked at our private equity and our private credit assumptions, those are 10-year compounded returns. And as Jay talked about, because there's a lot of implementation risk and illiquidity, when we come up with our expected risk, we arrive at a number that's much higher than the actual observed volatility of the return, which is how every other asset class is measured. We're trying to capture risk more broadly speaking. Private credit, if you were to look at our annualized return, our single year return for private credit, it's probably what, Jay? 9.5 or 10. But then when you put in the volatility over a 10-year period of time, it compounds down to 7.25%.
I think our private equity expectation is really 4.5. Then when you add in risk of implementation, it rounds down to 8.
So I guess I'm trying to understand, because are you expecting these target returns to be realized, or should we anticipate these returns actually being closer to what your 10-year forecast?
I'd say the managers that we have in front of you, we would expect to be closer to their stated target return. Not that there has been massive dispersion historically or quite yet in direct lending. I think the expectation looking at private credit and specifically direct lending as a whole, I think we will start to see dispersion, and as a whole, then that might go closer to 7.25. But yeah, our expectation is the manager shown should be around.
Here's one other thing I would say is that if we were to put in 11% as our expected return for private credit, it would tell you to put all of your portfolio in it. It would be 2.5 percentage points higher than private equity, which is not really practical, right? So there's that. And Jay talked about how there's relationships between the different asset classes. There's kind of this capital market line of, oh, I expect stocks to provide an excess return over bonds. And so where does private credit fit in that line? We're basically saying we think the returns are pretty comparable to equity over the next 10 years. I think you can look at it through different lenses and say like, well, if you think it's going to do the same as public equity for the next 10 years, that's a pretty positive view of it, right? So that's kind of, it's tough because it's not valued on a daily basis. It's tough to kind of fit in that mean variance framework that we talked about earlier. I think these are, achievable. It could be modestly less. I think 7.25 is conservative for, how these guys are underwriting loans, right? These loans they're underwriting are at these targets, right?
And are they shorter term loans generally? These funds, what's the typical loan length?
Yeah, and these probably more so around like 5-year.
Okay.
Yeah. ABF in the lower part of this chart here will be much shorter duration.
So Kaz, you'd expect that the more leverage you get, you'd get a better return. I'm not seeing it here. So are the assets different in the different things that's causing that to happen, or why aren't we getting a material expected higher return for having extra leverage?
Yeah, no, that's a great question. And so these target net IRRs are sourced from the manager, but we will go in and do our back end. I don't want to call it back of the napkin because it's more than that, but actually looking at where SOFR is, where the spreads are, looking at the.
Why don't they expect to have better returns if they're having extra leverage?
I think some of that could potentially be, which in these managers, I don't. So my mind is going a little bit ahead to like Apollo ABF, just looking at this page. They're targeting 10 to 14. That portfolio right now is about 80% what they call investment grade ABF. And that math just doesn't work for me or for our team. It's something that we talked about. Would definitely expect that more so around the 8 to 10. And in speaking with them, the plan is not to implement fund leverage to reach that return. It sounds like potentially IG ABF may not be as much of a focus going forward, or they think that there's some other pockets within ABF that are going to be more attractive relative value and maybe rotate into those. That's on that one. For direct lending, the part of it is due to leverage, but I think the expectation for them as well is just some potential defaults or shocks in other places of the market, pullback of retail capital flooding the market. I mean, we've already seen spreads in the last couple of weeks start to widen out just with the mass redemptions and a little less capital going in, which is good to see. But yeah, again, these are stated manager target IRRs, which we'll push back on, which we have. But they generally don't change just from us, asking sort of how we'll go through the calculations and be like, so it looks like it's more in this range, and we'll say, yeah, that could make sense.
Yeah, so two questions. The first one is just for my clarity, you're not doing a deep dive on the company asset level, correct? You're not doing evaluations on the companies that are inside the funds, correct? You're just doing
Yeah, I'd say we are not doing, it's tricky.
competitive
Yeah,
analysis of the company. of the
right.
Company asset.
No,
But how it relates to the fund, that's how you,
yes.
attribution and all.
Yeah, I mean, we just have to rely on the third party
Okay.
valuation consultants. We'll look at company comps,
Yeah.
and especially when we have the insight into the same borrower, and let's say a loan is held across different funds, that's one that will definitely, ensure that at least the marks are close.
I'm
but
clear. I'm clear.
yeah.
Second question though, is a bit broader. It involves about counterparty risk and distributions to Katie.
Hmm.
Okay, so I'm trying to keep it as simple, even though there are times it sounds more complicated than it needs to be. But I'm just trying to count the dollars that come into our plan so that we can pay our members, right? And the certainty with which those dollars come, right? So, Apollo, example. I know in 21 they bought an insurance company.
Yeah.
And in some sense, that provides a steady flow of cash coming in for them to meet any liabilities or obligations. And if all goes south, arguably they have a balance sheet that they could backstop any cash flow that needs to come to us, right? It's the float that is used in Berkshire Hathaway. Same idea. You buy an insurance company, you have the cash flow coming in from the premiums, you got to invest it. So it's actually a very beautiful, lovely business model. And you're seeing more and more of that happening, companies trying to buy insurance companies so that they can have that steady, permanent flow of capital to do these investments. So can you talk to that relationship? How steady is that really internally at Apollo? They argue the highest amount of returns for us. They have the lowest no lockup period. Sounds like a pretty good deal to me at the surface of it. But their ability to pay us our distributions relative to the invested capital, if you could speak more to that, you're saying all the right things about the other stuff, the other funds, but I'm really particularly keen on this one in particular.
Yeah. I guess what I'll say is thinking about the assets or portfolio companies and the interest, like that is held within the LP structure. And so the cash pay that you're getting from the underlying borrowers, that is contractually made to stay within that structure and go straight to the LP. And that's why you have a waterfall.
Right.
That's and so
it's a separate entity.
Right.
But if all goes south with that entity, how much do you know about Apollo's ability to then leverage its broader balance sheet for the complex, for the enterprise, to back up any commitments or liabilities that they have made by way of this deal to limited partners like us?
I mean, yes, like talking specifically to Athene, they definitely, I mean, I think that's a huge draw of having that balance sheet capital and being able to fulfill any liabilities that might pop up if and when that there's other verticals or other business segments that potentially don't do well. But I'm just thinking in this case, I mean, the assets that Apollo ABF is investing in are just such short duration and very cash, like income focused investments that I'm just thinking like if and when there's a big, shock or something like what you're referring to.
I'm just looking at Fat Tails, Black.
So, I
Black
mean,
Swan.
yeah,
certainly be a great question to ask too.
Right.
Yeah.
Right.
That's a question you can explore. How are you getting at a 10 to 14 with
Yeah.
no leverage? And
Are you putting up your balance?
yeah, like
sheet
what's,
as
yeah,
the
those
backstopping?
are all great questions to kind of
Okay.
ask at the
That's
interview
fair.
stage.
That's fair, Jim. That's fair.
Mhm.
That's fair. Thank
Yeah.
you. Thank
Yeah, no,
Because mitigating
glad-
counterparty risk, mitigating,
Yeah.
previous crises, or,
mhm.
threats of contagion.
Yep.
So thank you.
Yeah,
That's very
yeah,
helpful.
yeah, appreciate that, Jim. But yeah, I certainly did not want to gloss over that and also like
Sure, sure.
explicitly say that that stuck out to us, and looking at how they get to that was somewhat of a head scratcher as well. So we would put both Apollo and Aries more so in the same,
Similar bucket.
yeah, yes, asking us.
Thank you.
Yeah, thank you.
All right, so cause, getting out of the weeds, maybe going a little bit higher up. We're talking about, this list of semifinalists. How many finalists are we looking for?
So the goal would be to do one in core middle market, one in lower middle market, and one in ABF. So 3 total.
That was our initial thing.
Okay, so the bios are interesting. The numbers are in front of us. It doesn't, usually when we are discussing a new, bringing people in, being in the most liberal county and the most liberal state in the country, we are concerned about additional issues like the number of women in leadership positions in these companies. What are they doing for the environment? Risk of headline, who's investing in child labor and all of that. So those are something that we need to take. That's the money of the people who we're investing, and taxpayers in Marin. So before we can really select, we're talking about integrity and governance types of issues of these companies that I've never seen these words before, Audux and Golub and things. So very unfamiliar with these people. So how do we get that information? So
We'll definitely ask them to dive into those in the interview process. Yep.
Consider Maya Gladstone still being on the board, and what she would want to know, it would be women and climate and all that stuff. We need to.
Yeah, no, that's again, that's something we can ask them to make sure that they explicitly, proactively address and when they present to you. So again, a lot of good questions. There's no reason to make a decision today. We just think that this is kind of the best of the best in these areas. We wanted to kind of compromise between giving you like an exhaustive list of dozens of managers to try to figure out who to interview. We think this is the right group to interview, but we also wanted to provide you some choice. So this was the kind of the happy middle ground in that regard. That's kind of how we ended up.
And with Jim saying we can ask them these things, we have asked them everything that you see completed due diligence on. We have a full ESG questionnaire. We have to the exact number of employees, whether that's minority, women, military. We ask all these questions, and that's part of our standard full complete due diligence report. And that report is generally, when we do it, it's like 50 pages, very dense. And the ESG DEI portion of that is a good like 5 or 6 pages. So that is part of our process. And we don't do that just as a, formality. We think that there's lots of merit that goes along with having a sound practice, and that actually does help preserve capital at the end of the day. We do think so.
So with this process, we're in March. We're looking at 7, 8 names. Talking about a summer decision time frame. When how does this flow from here?
Kind of put that back to you and to Jeff in terms of organizing interviews and when and how to do that. Is it separate special meeting, multiple meetings, 7 in a day, a lot. So
Well, would
just
we
a
not
couple things to think about.
we're talking about going with 3 companies in the end, and these are, you're saying 7 we might talk to, or we would
Correct.
talk to?
That's what we were saying. Just because of the idea of doing middle market, lower middle market, and asset back. So those 3 categories, you've got three choices in one, two in another, and two in another. So that's why we're recommending all set, to interview all seven.
Can we get that down to 6? Maybe 2 for each? I don't know that we're gonna be able to
Yeah.
differentiate.
You could,
I mean,
Yeah.
you guys are doing the deep dive here. So, you know, frankly, this is for the $100 million we're talking about, right?
Right.
It's a
Yep.
Relatively
we could,
small decision. So
And
I think we gotta lean on the experts here. I mean, so I think 6 is even a lot. frankly, for me.
I was picturing paring it down.
I'd be
That's why I
happy
was
with one
asking
from
how
each.
we know who
you
to
know.
pair out from
Yeah.
here, but if we were going to talk to them, yes.
well, yeah, and we started this by, okay, let's pick the managers. If we were picking. But we didn't feel that that's kind of where how the typical process works here. We want to give you some choice. So we can come back and say, these are here's our choices. You can interview them and bless them, or say, yeah, I don't feel comfortable with that. Go on. Again, that's the balance that you have to decide as a board is, do you want to interview and make a choice, or do you want to hear like what we would?
But I think if we interview one, one only, we're comparing what to what, so.
Right. That's the trade-off.
Yeah.
In all other manager searches, you usually take a larger list, as Jim pointed out. This time they did not give you a larger list. They gave you more pared down, but you typically take a larger list and you pare that down, but you usually interview 4 or 5 managers. So you're really only talking about 2 more here.
2 is very reasonable. to me. I mean, 2 of each.
And I think the only challenge is that means that you're going to ask Callan to decide amongst your middle markets which of the 2 of the 3, because that's where you have 3. Because what I hear you saying is you'd interview the 2 lower, the 2 asset bath, and 2 of the middle market.
And for that, maybe I asked you Jim last time, how long have you had this practice on the private lending? Like Gaz's team? You have it for long?
Yeah, it's been since 2018.
Yeah.
Yeah.
And how many other clients do you have that do have private credit that you're advising on a regular basis?
Any idea as to what the total number is?
Yeah, it depends because there's a number that we only do alternatives consulting for, which includes private credit. And then there's a smaller subset where we'll only do private credit or only do private credit and private equity.
And then
That,
general consulting clients that do private.
yeah.
So there's a couple of different types.
Yeah, so I'd say my role is very much so a two-pronged I'm both a consultant and on research. So I'd say I personally work with 12 clients or so, that like myself and our team are the consultants on, where it's not necessarily going through a general consultant.
Those are dedicated private credit consulting assignments. And then there's going to be a multiple of that of general consulting clients that are doing private credit and are building out this. So the number is going to be pretty extensive.
Yeah, so you're familiar with 25 or 30 different private credit managers just from existing relationships.
Yeah, more than
Oh
that.
yeah, like 100. Yeah. And can I share our search stats from last year?
Sure.
Because I think that would paint a picture. So for instance, last year, 2025, Callan clients committed $14 billion to private credit. And in the year before, it was around that number as well. I believe that consisted of 41 commitments across 32 firms, I believe, or something like that. But the point is that that's a very large number across a number of strategies in just 1 year. And so, and that is everything that we do, on a specific private credit consulting relationship is like our whole team. It's always all hands on deck.
Cause doesn't sleep is what he's trying to say.
Oh, no, no, no. It's actually fun. It's not bad.
How many managers in your data, have you, are in your database now, last year?
How many
How many
managers
have you
are
screened?
in our database
Yeah.
currently? And does that include?
No, I mean, just private credit.
I'd say firm. There's probably like 200 firms, 250, and that's across
And
600-700.
I would say it's growing
strategies.
just because there's the asset class is growing. And I'm seeing at least there's a lot of niche kind of lenders or strategies that are coming to market, right? Things that are very specific on, sports royalties, things like that. So there's the list is growing.
Of those 200 emerging managers, how many, roughly?
Yeah,
How many,
absolutely.
roughly?
Good number. I'd say for firms, probably like 15, 20 or so. And we have market maps put together on these various verticals within private credit, and we also do for emerging managers as well. So
And we're happy to get you. I think we've provided it when Kaz came in and talked before. We shared all these stats before, and we showed our forward calendar and kind of the universe. We're happy to update that and give it back to you at any point in time if that's useful. So, but yeah, busy area.
So I want to thank you for this presentation. I appreciate the criteria that you are going through and looking at each of these managers. For myself, I'm really interested in the last criteria, which is their experience in dealing with loans that go south. So when they come in and talk to us and you and your discussions, I would like them to go into some detail of their actual experience and staff in dealing with loans that go south. And if they've never had one that went south, I would say that's maybe a negative.
Yeah,
Good and bad.
I think it is in a way. Yeah.
That
gonna happen.
they're set up.
Yeah.
They're set up with the proper covenants and experience and so on to work these things out. And in some of my personal experience, I've known managers who, when the loan goes south, they actually make more money. Because they're so experienced in how to work these things out, opposed to just sitting in some office in Boston and saying, I don't know what the hell this stuff is.
Definitely ask them to, spend some time on that as part of
Yeah. Yeah, you never want a lender to go into a deal expecting to take the keys to a company, but if they have the capabilities to turn that around quickly and get value, that's something we ask. So yeah, happy. And throughout this process, this isn't just, a full handoff, like go ahead and do your diligence. Like we will, we'll be with you side by side and can help prep the specific questions to ask and people to meet with. Absolutely.
So, Mr. Chair, I think that what's in front of the board at this point is you've got 7, you can interview all 7. You want to interview less, you want to do it at the next investment committee meeting, you want to do it at a special. Those are the things.
Does anyone else think we should reduce the middle market direct lending to 2 names to bring in?
I did 2 of each, so 12.
Please eliminate one of the middle market direct lending semi-finalists, and let's try to do it the next.
Okay, great. We will work with Callan on the list of managers that you will interview for your June.
Right.
Good
Thank
luck.
No, happy to do that. 5 minutes on performance, which is the last item.
Yes,
Eugene,
please.
5 minutes, a lot of pressure, Eugene.
Eugene, you're still here?
It's generally a good story, so.
This performance report will exclude the last 2 weeks. Right?
Yeah, no, this is through December. Yeah. I think we have an update through February.
February.
Yeah.
We've got a flash
We got a
report
flash
through
through February.
through February, so it will not include March.
No much, no much.
Chris, while they're getting set up, just a question. I know Jim was recommending, actually, I think if I heard him correctly, that we consider reducing our small cap exposure since it's so large. I'm not sure we close the loop on that, or that's something we're going to talk about before this meeting ends, but I think we should look into that. And I wasn't sure if the board felt like we're going to just stay at this overweight or not. So I'm not sure if anybody else had any uncertainty around whether that was coming up before the meeting ends or whether we decided we're not going to change it in spite of the fact that Jim says we're overweight considerably and the strategy has not kept up with the broader market.
Well, we made
So-
a decision by not making a decision.
Correct.
Right, well, that was clear.
So
Yeah.
you didn't make a decision. There was nothing taken. And what I would say is if you want to consider that, then we would agendize that for that discussion for your next meeting,
Okay, I'd like to add that to the agenda for the next meeting.
subject to the chair wanting to add.
Yeah.
The good news is that most of that material was already exists.
Yeah, we're happy to continue, so.
Thank you.
Okay, with that in mind, I will do my best to keep it under 5 minutes. So here we see the fund asset distribution. Just a couple of things to note. The public real assets fund allocation is now 0. The BlackRock TIPS index fund has been liquidated. KBI has been allocated towards the international equity allocation, and BlackRock REIT index now sits within the real estate allocation. Moving on to page 13, we have now a formal private credit allocation, as you'll see, no longer, so that's now 5%. As Cos has talked to, we will work to build that up to full weight. The other thing to note is if you just look at the net cash activity column, so for the quarter, $54 million out roughly, investment gains of $65 million in roughly, leading to a total increase in fund size of about 10 million. So just sometimes it's important to
And
talk
just,
to-
and just one thing to point out, if you look at the last line under private credit, you see the futures position,
Right.
the parametric futures position that came in. So because we codified that 5% target, and because your existing exposure to the 3 managers is well below that, they're using futures to get us to that 5% target. As you fund select managers and fund that 100 million, the futures will go away and actual manager exposure will go in. So just wanted to point that out because it stands out. It's a big number.
Right. So, and again, just to just say that we'll get towards a full allocation as that 100 million comes in and the 60 million the year after. But in terms of dollars and cents, the total fund, even after pulling out 54 million in cash during the quarter, has increased by 10 million, just putting dollars and cents on it. Turning now to page 14, performance. This is where it's a good story. Absolute performance for the year, last year through December 31, 14.67% on a net basis. You know, very strong absolute returns. We've seen very strong performance from equity markets. In particular, the international equity markets had an extremely strong run. The portfolio's international equity returned just over 33% for the year, so pretty exceptional. When you're looking at relative performance, hasn't quite kept up with the fund's target. That's attributable to 2 main sources. One, the overweight to small cap. Large cap has outperformed small cap. And then within small cap, in the domestic equity, the small cap manager has not kept up with the benchmark. That is largely attributable to a junk rally last year that we saw. DFA tends to have a bit of a quality tilt, and therefore when these non-principal companies start to really run fast, that's when DFA will lag. However, longer term, over 5 years, DFA has outperformed the benchmark by north of 3%. The other thing to point out is, again, with public markets, public equity markets running so hard, private equity markets tend not to keep up. It's just a tougher bogey. Moving on to the fiscal year to date, so this is 7/1 through year end. Again, from an absolute performance point of view, pretty strong, 6.5% on a net basis. Solid returns for the fund. Pretty happy there. And keep the good news. I'll keep it brief. Finally, on private equity, looking at the total value to paid in capital, we're now sitting at 1.98, just shy of 2x multiple. And then in private credit, looking at a total value to paid in capital sitting at 1.26. Other comments to make in terms of the watch list, no change there. And with that, I'm not sure if I didn't time myself, but I tried guessing.
Well done.
That's the short version. So generally a good story. So.
Generally a good story. Yeah, north of 14% on a year in absolute terms.
No real pain points.
Yeah.
Few headwinds.
Right.
Public markets better than private, large better than small. So those hurt your relative returns, but absolute returns.
Any comments or questions on the quarterly report? And the flash report? All done?
Want to hit that quick? Yep, so they're all the details here, but on this last page, you can see that the fiscal year to date, again, through February is preliminarily 11.1%. So again, pretty strong so far this year. We're saying through the first 2 months, total fund up a little north of 4%. Add that onto the 6.5 that Eugene showed you in the other page. So 11.1. Probably a little softer here with March performance, but still trending north of the 675 target. Still a long way to go, unfortunately. So, and with everything going on in the world, see how it plays out. But again, things are looking pretty good. This is preliminary. These marks, especially for anything that's private, we're not 100% sure on, but we do our best just to give you a sense.
Thanks for all the great
you.
information today, Callan, folks, and meeting is adjourned.
Thank you.